Hello, everybody. Let's see. Before we start, I'm going to unmute everybody just in case you have any questions that you want to pitch out before we start. Self-muted. Okay. Let me make sure I've unmuted everybody here. Okay. All right, self-muted. All right, how you doing? You can unmute right now. Getting a call. Oh, I think I got someone who's having trouble getting on. Hold on just a second here. Hello. Hey, how you doing? Yeah, are you doing life and health? Property and casualty. Same as fire and casualty. You got it. Well, good. All right, bye-bye. Okay. All right, let's open it up. Any questions before we start?
Yes, Lauren. I got a question about navigational limits.
Okay. For ocean marine coverages.
Absolutely. It was one of the questions that showed up on the exam that I was totally just dumbfounded. I had no idea.
Gotcha. All right. So on land we have territorial limits. Like I'm in here. I'm not sure what state you're in. I've got like a blend of all kinds of people in here. But in California, if you have a personal auto policy, it covers you basically anywhere in the U.S., Canada, U.S. territories. But there's absolutely no coverage in Mexico. So that's a territorial limit. So on water we have navigational limits. Okay. And so let's say we'll cover you pretty much anywhere in the world, but we won't cover you off the coast of Somalia because there's pirates. Parts of the Caribbean because there's pirates, and now actually parts of Mexico there's actually some pirates off the coast, and so these are hostile waters where we will not cover you.
Okay, because it's okay.
All right. Oh, somebody's chasing the kids around the house with it.
If I'm not hogging, I do have one other question too that showed up on the exam that kind of dumbfounded me last week.
Ask away.
Are coverage extensions in essence the same as endorsements?
Okay, the difference between endorsements and extensions, endorsements are additional charge for additional features and benefits. Extensions are free as long as you carry 80% of coverage to the value of the property.
Thank you.
Okay. Yeah, so if you have a commercial property policy and you carry 80%, there's 5 extensions that you get for free. $250,000 for a newly acquired or constructed property, $100,000 for contents in the property, $10,000 for property off premises, $2,500 for signs. And there's one more, but it's not important. Yeah.
That was exactly it too, where you said the $250,000.
Yeah. So actually, on my YouTube channel, I have a commercial property webinar, and go into that one because it'll dive more deeply into it.
Because after I got my test results back, CPP was where I needed to focus.
Yeah, so the commercial package policy, which sometimes you'll see it, commercial package policy parts, like coverage parts, or typically on your test they're using the words modules. Like a modular policy. So if you bought one line of coverage like commercial auto, that's a monoline policy. But if you bought 2 or more coverage parts like property and liability, that would be a modular policy.
Thank you so much.
Oh, you got it. All right. 14 registered, only 4 on the line. Any other questions? Christopher, Julia, Robin? Okay, here we go. Sorry, Christopher, I had you muted there. Sorry.
No, I'm okay. Thank you.
All good? Okay. Wow. All right. Well, I guess we'll go ahead and get started. I'm not going to wait for other people. I'm going to leave it unmuted right now, but if it does get noisy, then I'll go ahead and mute it, but I'll make the announcement before I do. Okay. So yeah, anything comes up, just chime in. If you want, you can go ahead and self mute until you get a question. As we go through this, my recommendation is get the slide number. So if you have a question as we go through this, write the slide number down. About halfway through, when we get to the personal lines, the end of the personal line section, but before we start commercial, there's a little break in there where we can go back and take another look at that particular slide if you need more clarification. Okay. So, but with that, let's go through it. Okay. If you have not registered, whoops, do I have that? Oh, there we go. If you have not registered, you can go to lgdstudy.com. The property and casualty program that I have is only $50 and allows you access to me. I have 7 exams on my website. If you're in California, you're going to love it because they're very, very similar to the actual test you're going to take. Okay. Other states, the concepts are there. My questions might be a little more difficult than your actual test because California has some pretty unique test writers. Right. But the concepts are same throughout the country, so don't be shy. If you do have questions, there's my cell phone number. Okay. Of course, during the webinar, I can't pick up. Sometimes in the mornings, I do have training. So afternoons, evenings, and even weekends, if you do have questions while you're studying, reach out to me. There's my email. You can either go to the website, lgdconsulting.com, and click the contact us and email me there, or you can just email me directly through here. So, and I do check my emails periodically throughout the day. So if you have a question, just let me know which question or which exam if you're going through my material, and then I can reply with an explanation. All right. So I don't know how to help you if you don't let me know the weak spots. So be vocal, okay? So just give you a heads up. All right. The exam here in California is 150 questions. You only need 60% to pass. Now that's here in California. In other states, you need 70%. All right. California, like I said, we got our own unique test writers that make it very difficult for people to pass, but it is passable. You do have to take some time and energy. Seems like a headache, like, oh, God, I got to study. But it's worth it because once you get it, the continuing education is easier. It's an open book exam online, and you need 70% on an open book exam for continuing education. That's a piece of cake. So out of 150 questions, 60%, you can miss 60 questions and still pass. For those of you that have a 70% passing state, that means out of 150 questions, you can miss 45 questions and still pass. So that's a lot. So if someone says, "Oh man, I missed it by 2," no. In California, you missed it by this 60 you're allowed to miss plus 2. So that's 62 questions out of 150. That's a big gap in your studying. Um, so, but don't get discouraged. A lot of people take this test personally, and you can't. This test is pretty tricky in the verbiage, the double negatives, and the language that they use. You almost don't recognize what they're asking. And I'll give you some examples in the presentation tonight. For 150 questions, you have 3 hours to do it. That's like a minute, 20 seconds per question, which is plenty of time. Every once in a while, they'll give you 5 to 10 additional questions. These questions do not count towards your score. The problem with that is you don't know which 5 or 10 are those random questions that they're trying out. Okay, so do your best on all of them. Okay, so all right. So let's dive into this. Just look at the title. The test you're taking is either the property and casualty test or the fire and casualty test. Now, property and fire are interchangeable. Your homeowner's policy is a property policy. Your homeowner's policy is a fire policy. It's the same thing. Okay, again, there's 2 ways of saying the same thing. A property loss is the same as saying a fire loss. So don't get bogged down just by that. Okay. So property, that covers your stuff, your house, your car, your belongings. In a contract, that would be you and your stuff. That means as an insured, the person purchasing the insurance, you are a first party to a contract. The insurance company is a second party to a contract. So in general, insurance is a two-party contract between the insured, the client, the first party, and the insurer, which is the insurance company, the second party. Okay. Anyone that other than those two is a third party, and that's part of casualty. Whenever you see third party claim, that's usually a liability claim. All right. So casualty protects against a number of occurrences, and the biggest area of casualty coverage is liability insurance or liability coverage. The easiest way to remember this is whenever you see L for liability, think L for lawsuit. You injure someone else, you damage someone else's property, and they're going to sue you to pay for the damages. And so you damaged their house, you damaged their car, or you injure them. All right. So in a contract, that would be we are covering them or their stuff because of your actions, as long as it's not intentional. Okay. And so that would be a third party. So always remember, third party claims, think liability. All right? They go hand in hand. As far as contract law, you're going to get the definition of insurance as a question probably 2 to 3 times. All right. One of the questions is going to be insurance is defined as which of the following, and it's a one-word answer. Look for a contract. All right. You may get a little more than that. It's a contract to indemnify another, all right, or it's a contract to restore you to what you had. Right? Or you might get the technical definition. It's a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. Right? So I don't know which definition you're going to get, but you will get the definition of insurance on your test. Insurance is a contract of indemnity. Indemnity means to restore you to what you had before the loss, to make you whole again. So if there's a 3-bedroom, 2-bath house before the fire and you have proper coverage, if the house burns down, the insurance company will cover the cost to rebuild the exact same 3-bedroom, 2-bath house after the fire. See, we're not going to give you a 5-bedroom, 3.5-bath house with a sun deck, a pool, and a jacuzzi and some skylights that you didn't have before the fire, because that was a gain that improved your condition. That's not what indemnity is about. Indemnity means to restore you to what you had before the loss, and that's it. All right. Now, in order to buy a policy, you have to have insurable interest. Insurable interest is defined as having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. All right. Simply put, in order for you to insure something or somebody, if that something or somebody were to suffer loss, you're financially affected. So you can insure your house because if your house burns down, it will cost you money to rebuild it. You can insure your car because if you got a ding in your car, it's going to cost you money to fix it. You could not insure your neighbor's house because if your neighbor's house burns down, financially, you're not affected at all. In fact, if you got paid out, that would be a gain for you. And that's not what insurance is all about. Okay. And so look for economic or financial interest in whatever you're insuring. All right, keep that in mind. Risk, the key word for risk is uncertainty. Risk is defined as uncertainty of a loss. All right, see, your house may burn down, it may not. You may get into an auto accident, you may not. See, it's uncertain. Because if it's a certain loss, an insurance company wouldn't insure it. All right, so if there's a brush fire already heading towards your house, and now you're calling up to buy insurance on your property, it's too late. That's a certain loss. The fire's already on the way to your house. I mean, who would want to insure a house when the fire's already heading towards it? You see what I mean? That's a certain loss. We don't cover that. So risk, look for it. The loss must be uncertain. There's 2 types of risk: pure risk and speculative risk. Speculative risk. Let's start with that. Think of gambling. When you go gambling, you could win money, you could lose money. You could break even. All right. But if there's a possibility of loss or gain, we won't insure it because remember, insurance is not there to give you the gain. We only insure pure risk, which is possibility of loss only. All right. So again, you get a debt and offender, we cover the cost to fix the debt. The loss doesn't have to be great. Again, a dent in your fender shouldn't bankrupt you, but it will cost you money to fix it. If you don't fix it, well, then if you sell the car, you'll get less than what you thought because they'll point out, hey, there's a dent. You see, they don't want to pay full price if there's a ding in it, right? So you got to know the difference between those two. You will get 2 or 3 questions on the definition of risk, pure risk, and speculative risk, okay? Loss is a reduction in the quantity, quality, or value of an asset. And again, like I said, the loss doesn't have to be great, but there's got to be a financial attachment to it, okay? Peril is a cause of a loss. This is important. You got to get this down on this test. You're going to get questions about perils all over the test, and sometimes you won't even recognize it. Okay. So fire, explosion, flood, cancer, AIDS, those are common perils. They cause loss. All right. So keep that simple, right? Keep it straightforward. A peril is defined as a cause of a loss. Now, we also have cause of loss forms. All right. And so we have named peril forms, which list perils we cover, basic, broad, and special. I'm sorry, basic, broad, and earthquake. Those are named perils. Okay. And then we have open peril, which is also called all risk or special form. So the difference between the two is the named peril forms actually list the perils that we cover. So if it's on this list, it's covered. If it's not on the list, then it won't be covered. So it's very limited because you can only list so many items. Excuse me. Then we have the open peril or all risk form, which has a list of exclusions. So it's the opposite. We have a list of exclusions like catastrophic exposures like earthquake, flood, nuclear risk, war, right? Also, intentional action, wear, and tear are never covered by insurance. And so named peril forms list perils we cover. Open peril forms list exclusions. That means with an open peril policy, we cover anything that you can possibly think of that damages your house or property, except for this list of exclusions right here. You see? So if it's not on the list, it's covered. So it's very comprehensive. All right. Now, excuse me, I still got a cough. I apologize. So a peril is defined as a cause of a loss. So a cause of loss form is a form that lists perils. All right. People get tripped up just by that. So either list perils we cover or list perils we don't cover. Okay. Hazards. Excuse me. All right. So I apologize. I have a bit of a cough here. There's just one just dry spot that just can't seem to water down for some reason. So I apologize. All right. Hazards. It's defined as actually hazards are conditions that increase the likelihood of a peril or loss occurring. All right. There's different types of hazards, like a physical hazard. That's something you could reach out and touch. Badly worn tires. If you have badly worn tires, you're more likely to get into an accident. So you see how this hazard, the badly worn tires, increases the likelihood of suffering a loss. That's how you need to know what a hazard is. There's different types. I just described physical. Moral ends in an L. Excuse me. Moral ends in an L, and L is for, think of lying, cheating, being dishonest. Okay. Welcome to the world of auto insurance, because that happens all the time. You even let the clients know, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? And people will still say no. And when you look it up, they've got like 6 items, they'll lie to your face, but they're just hoping it doesn't show that they get the better rate, but it does. Insurance companies talk to each other. Okay. So that's an example of a moral hazard. So moral ends in L, L for lie. Morale, think of more ale. When you drink more beer, people get careless and clumsy, right? You get that liquid confidence. You do things you normally wouldn't do. And so morale would be an indifferent attitude on the test they typically use. Someone who is a risk taker. They go skydiving, scuba diving, okay? Bungee jumping. They drive fast. We look at their motor vehicle report, they got a couple speeding tickets. You see what I mean? So that's a different type of mindset than someone who's lying, cheating, being dishonest, right? You got to know the difference between those two. You'll get a question on one, you'll get answers on the other. So you got to watch out for that one. Legal hazards are people that are going for more money than they're legally entitled to. It's a 5-mile-an-hour stop and go traffic, and then one guy gets bumped from behind, hangs up his cell phone, clutches the back of his neck, opens the door, falls to the ground, and then claiming, hey, call an ambulance, and trying to sue for $2 million, claiming soft tissue damage. Okay, so there's not even a scuff on the bumper to show that they got hit. But now they're trying to sue for $2 million. You see, and so the insurance companies may have to defend this claim, and it's going to cost money. They may offer a settlement, which costs money. You see what I mean? And so that money to cover that frivolous lawsuit, that all comes from all of us paying higher premiums. So legal hazards are those people that are going for more money than they're legally entitled to, and we are all paying for it with increased insurance rates. Okay? So, yeah, know the different types of hazards. Some sample test questions. Who is considered the first party to an insurance contract? Remember, that's the insured, the client. So who is the second party to an insurance contract? That's the insurer or the insurance company. And the third party is anyone who is not the insured and the insurance company. All right. So in a commercial property policy, the company providing the insurance is referred to as we or us. All right. So we or us are going to cover you and your stuff. Okay. And also possible losses against them and their stuff. All right. So this is all contract law, contract terminology that you need to know for this exam. All right. Even though you'll probably never use it once you pass this exam. Okay. Get to know the parties that are selling insurance or offering coverage, I should say. We have an insurance agent, we have an insurance broker on the property and casualty world. Okay. As an agent, you are contracted by the company, and your job is to sell insurance to the public. Okay? We, the company, pay you commission. We appoint you as our agent to sell our products. Now, as a broker, you don't sell. A broker represents a client, charges them a fee, and places business with, but not on behalf of an insurance company. So brokers don't sell insurance, brokers secure coverage. Only agents sell insurance. This is kind of tricky because, you think, well, brokers and agents, they both sell. Well, yeah, in the real world, you can call it that, but the test world, no, no, no. Agents sell, brokers secure or procure coverage. Agents represent the company, sell to the public. Brokers represent the client and place business with, but not on behalf of an insurance company. An agent is appointed by an insurance company. A broker has a selling agreement with an insurance company. Okay. And so the broker has to post a $10,000 bond to protect client money that they're collecting. Okay. Making sure it gets to the insurance company. All right. So know the difference between those two. Now, neither one of these two parties can sell life insurance because whenever you see insurance agent or insurance broker, that's on the property and casualty world. That's the auto, homeowners, commercial workers' compensation side, which is what we're talking about. But there's insurance agents and there's life agents. Insurance agents are agents that sell insurance. They sell property and casualty insurance, and they can transact all types of insurance except life and or disability. And by the way, for the test, disability is the same as saying health insurance, right? Life agents sell life and or disability. You got to keep the two licenses separate. All right. So insurance agents do auto homeowners, life agents do life and health. Okay. Keep it separate. But in both cases, as an agent, you represent the company. You're contracted by the company. That means you have an action notice of appointment from an insurance company appointing you as an agent to sell their products to the public. And when you sell their products, they pay you in commission. Okay. So that's how you need to understand that. So which of the following best characterizes a speculative risk? Remember, speculative risk, think of gambling. There is a possibility of loss or gain. All right. What is the type of loss exposure that would include land and the property attached to it? Well, this would be liability, because in property insurance, you cannot insure land. See, if your house burns down, no, we get property coverage to rebuild the house, but for property, we cannot insure the land. Because, if your house burns down, if you take a really good look, you'll notice that land is still there. Well, it's a good thing you didn't lose that in the fire, huh? And so we don't insure land with property coverage. However, someone could slip and fall on your land, and that's a liability exposure, and that's what we're looking at. All right, so always remember that. All right. Which of the following types of loss would result in a claim for monetary damages due to injury to another or damage to another's property? Well, if it's not you, the first party, it's a third party, and third party are liability claims. Okay. And so you got to get the property is my stuff, liability is their stuff. Okay. Because that's going to help you a lot in the questions because they will, of course, word it to confuse you. So just take a look closer at the question. Is it a loss to my stuff or is it a loss to someone else's stuff? Okay. All right. The possibility of financial loss resulting from the ownership of property would be known as, and that's insurable interest. Now, in the property and casualty world, you actually have to prove insurable interest 2 times. So if you're buying a house, well, in order for you to buy a policy, you got to prove you're going to own that house. And so the escrow, they're going to set that up. Okay. But when you pay for this policy, if a loss occurs, when the loss occurs, you have to prove insurable interest again. You have to prove it's still your house. All right. So all of your property and casualty policies are short-term contracts. Short-term contracts means they're good for up to 1 year. All right. So let's say you bought a house for $300,000. You bought a homeowner's policy to protect the house, right? Because your house, you paid annual premium. So the whole year's paid up. All right. The house burns down in September. All right. Let's say you bought the house in January. 9 months later, the house burns down in September. You have to prove you still own the house in order for you to collect. Okay. So let me explain. Let's back this up again. You bought a house in January. You bought a homeowner's policy. You paid annual premium. 6 months later, your house doubles in value. And so it's appraised at double your purchase price. So you're going to sell the house because it doubled in value within 6 months. So you sell the house, you get more money, you buy a bigger house. Okay. But you never canceled the homeowner's policy. So remember, you paid annual premium. You sold the house 6 months into this policy. You still have 6 months coverage pending. The house burns down in September when your policy is still in force. You cannot collect because you don't own the house anymore. You cannot prove insurable interest in September when the house burns down because it's not your house. You sold it to someone else in June. Does that make sense? Okay. So you have to prove insurable interest twice: when you buy it and when the loss occurs to collect. One more thing about insurable interest: even though you're expecting to inherit a property, you cannot insure it until you actually own it. And so this happens on the property and casualty test where, it says there's a grandfather, he owns a house. In his will, he's going to leave it to his grandson. So the grandson runs out and buys a homeowner's policy on the house. The house burns down. Can the grandson collect? No, because nowhere did it say grandfather died. See, grandfather owns a house. In his will, he's leaving it to his grandson. So grandfather never died. So the grandson legally should not have been able to buy the policy. Okay. So it seems kind of tricky. The test wants to make sure you understand the concept that you have to have insurable interest, not have an expectant interest in order to buy a policy on something. Okay. Bill and Bob have equal ownership interest in a building worth $100,000. Bill purchases a property policy on the building for $100,000. Bob was not listed on Bill's policy. Bob does not buy his own policy. If the building were to burn down and it's a total loss, how much would each of them collect? Okay. Now, a lot of people say, well, Bill gets $100,000, Bob gets nothing. Okay. The problem is Bill only owns half the building. So Bill and Bob have equal ownership in a building that's worth $100,000. That means they each own half of that building. So Bill collects $50,000 because that's his half. Bob gets nothing. See, if Bill collects $100,000, Bill made a gain. You see, so that means if they didn't, it wasn't a total loss. If it was a $20,000 loss, they'd also split that $20,000. Bill can only collect $10,000, and Bob hopefully buys a policy by that time and collects his $10,000. Right. So in this case right here, Bill is overinsured, and Bob is underinsured. Okay. Now in the real world, this typically is not going to happen, but remember, the test world, they want to make sure you understand the concept of insurable interest. Okay. What type of exposure can best be defined as a condition or situation for any exposure or financial loss which is presented to an individual or family? Well, if it's individual or family, that's personal. All right. Another way of phrasing this question is if it's a human loss. Human loss is still family. Okay. But they may change this where it's what type of loss is a business exposed to death, retirement, resignation, or disability of a key employee. Now, if it's employee, it's work, that's personnel. So personal is family, personnel is work. Okay? So in California, if you take the test in California, you'll get one, if not all three of these questions we just covered right here. Very common, very common. Where do insurers get their policy forms from? The ISO, which is Insurance Services Offices, that's for the prop casualty world, and the NAIC, which is National Association of Insurance Commissioners, and that's for the life and health world. So insurance companies get their policy forms from the ISO, the NAIC. They change it up, put certain conditions in it based on their attorneys and their loss histories, and then they have to file their policy forms with the Department of Insurance. Right? So they get the forms and data for pricing from the ISO or NAIC, and then they have to file them for approval with the Department of Insurance. Okay. Contract versus policy. Contract is contracts in general. This is part of contract law. So consideration. These are the four parts of the contract. I use CLAC, C-L-A-C. So C for consideration means an exchange of value. The act of filling out the application, paying the premium for the promise of receiving benefits if a loss occurs. That's what consideration is in insurance. Legal purpose or legal objectives, two ways of saying the same thing. Your test does go a little crazy with the thesaurus, all right? A lot of times you'll see legal purpose in all your studies, and then you take the test and they say legal objectives. All they did was use a thesaurus word, okay? But it means the same thing. It's to protect against a loss, okay? To protect against a loss in insurance also means you cannot get a gain. So there's two ways of saying the same thing. Protecting against a loss means you cannot get a gain. That's what legal purpose is. Agreement is broken down into offer and acceptance. In insurance, the insurance company, through you, the agent, make an offer. All right. Hey, we want to offer you insurance to protect your, situation. Okay. And so you're making an offer. The client has to accept the offer. And so you're right, I do need insurance. So they fill out the application, pay the premium, and they give it back to you. And that customer has just made a counteroffer. Here's the information you requested and the premium that you're requesting. Can you insure me at what you put in your proposal? So the insurance company accepts this counteroffer, underwrites it, says, you had a prior claim. So we can accept this, but we're going to have to charge you more premium. You still want the contract. So here is another possible counteroffer going back to the client. Okay. And then the client says, well, I need the coverage, so I'll go ahead and take it and pay the higher premium. Okay. So it really doesn't matter who makes the offer. Both parties have to agree to the conditions in the contract. The clients have to agree to pay the premium, right, and follow the procedures in the event of a loss, and the insurance company has to accept that premium and cover them at that price should a loss occur. Okay. So that's what agreement means. It means offer and acceptance. Okay. In insurance, you can only deal with competent parties. That's people who are legal age, mentally competent, use your best judgment, not under the influence of alcohol or drugs, because then their judgment impaired. Legally, they cannot enter into a contract. Okay. And so you got to deal with competent parties, people in their right mind. Okay. Now that's contract. Now for a policy, we've got four different parts, and I use DICE. Declaration page is the first page of the policy, summarizes the coverages, states the premium, and tells you who the insurance company is. Right? A lot of people call it deck page, deck sheet, but when you're dealing with the public, just say, hey, can you send me a copy of the first page of your policy that shows, the coverages that you're carrying. Okay. Being new, you don't want the insurance lingo going out to the public saying, hey, fax over your deck page. And your clients are just like looking funny going, what the hell's that? Okay. So when you're out there selling, keep it simple. All right. The insuring clause or insuring agreement. A lot of times this is part of the declaration page. This basically just tells you the type or kind of policy you bought. So you might get a test question that says that the clause that describes that an individual purchased a personal auto policy would be which of the following? That'd be the insuring clause or insuring agreement. Okay. Again, clause and agreement, your test just goes crazy with the thesaurus. Conditions. Conditions clause or conditions agreement. This spells out the duties and rights of both parties. The common terminology that's used on the test is it spells out the obligations of each party. Clients are obligated to submit proof of loss, right? And if a loss occurs, and the insurance company is obligated to investigate, settle, and pay the claim. Okay, so you have to meet certain conditions in the contract to collect. That's what the conditions clause or conditions agreement is all about. Exclusions is quite simple, just tells you what the policy will not cover. Okay. Two other parts of a contract, definitions, so you know what bodily injury is, you know what property damage is, you know the definition of occurrence. Occurrence on your commercial general liability policy is defined as continuous and repeated exposure to the same general harmful conditions. Okay, so I mean, it's going to have definitions like that in the definition section. Endorsements, additional charge for additional features and benefits. So remember, endorsements versus extensions. Endorsements are additional charge, extensions are free as long as you carry 80% of coverage to the value of the property. Okay, and we'll get into that in a little bit. Personal auto coverage. I'm using California. All right. Some states are a little bit different, but in California we have split limits. The minimum liability to register your car and operate it on the roadway is 15, 30, and 5. Those three numbers stand for 15,000 is the first number. That's bodily injury per person. 30,000 is bodily injury per all persons in that occurrence or accident. And then the third number is the 5 is for 5,000 for property damage. So this is liability. So it doesn't cover you. This covers the people you hit with your car. Okay, so keep that in mind. Liability is the other people. Okay, so 15,000. So if you hit a vehicle that had two people in it, we pay a maximum 15,000 per person. So let's say one suffered, 18,000 and one suffered 20,000. Well, they each get a maximum 15,000. Okay, now if there's a third person, we're going to pay maximum 30,000 for all people in the accident in the other car. Remember, it doesn't cover you and the people in your car, it covers the people in the other car. So no more than 15,000 for any one person, but no more than 30,000 for all the people in that accident that you caused. Okay. No, excuse me. The third number, the 5,000, that's what we're going to pay to fix the car that you hit. Okay, that's how you need to understand that. So if liability covers the other people in the other car and their car, medical covers you and the passengers in your car. Now, in the real world, a lot of people say, I don't need medical. I got HMO at my work. I got a $20 copay. Well, that's awesome for you, but you ever have your friends riding your car with you? So if you get into an accident, it's your fault. Is your HMO and your $20 copay going to cover your friend who got injured next to you? No. Well, that's what medical is for. This helps cover their medical up to the limit you set. I'm using 2,000 because it's a common number they've used on the test. Okay. So medical is not necessarily for you, but it does cover if you're injured in and around a vehicle. That can include you accidentally slammed your daughter's hand in the car door. Did they get injured in and around the vehicle? They can use their auto insurance medical to help cover the immediate costs associated with that. Okay. People don't realize that. This can also cover you as a pedestrian. All right. Now the test, they use some funky terminology, right? To where, medical payments under a personal auto policy provides coverage for which of the following. And one of the crazy answers I saw was someone who is injured while alighting from a vehicle. Alighting, ALIGHTING. So you're injured while you're getting out of your car is basically what it says. And that's covered. Okay. Uninsured motorist. I've combined it here with underinsured motorist. Uninsured motorist is you got hit by someone who doesn't have insurance and it's their fault. So this only covers you and your family members that are injured because someone without insurance hit you and injured you. This is bodily injury to you. Underinsured motorists kind of follows the same situation where someone else hits you, it's their fault. They have insurance, it's just not enough to cover your medical bills. And so your policy can pay the difference between their insurance limits and your policy limits to take care of you. All right. So this is the only liability coverage that actually covers you and your family because you got hit by someone who doesn't have insurance and it's their fault. That means they have to meet the definition of uninsured motorist. So someone who doesn't have insurance, that's pretty simple. Hit and run driver, we chalk up to uninsured motorists. The reason they ran off is because they didn't have insurance. Because if they had insurance, they'd just stop and let the insurance take care of it. Okay. Someone who says they have insurance, but the insurance company went bankrupt, that means there's no insurance behind it. Someone who says they have insurance, but the insurance company denies the coverage. That would be someone who bought the insurance to register the car, then they drop the insurance. They get into an accident, and they show you the insurance card, which is still good for the policy period, even though they only paid 1 month's premium and dropped it, you see. And so, in a sense, they really don't have insurance. And so that would be uninsured. Now, you're noticing for uninsured motorists, there's only two numbers, 15 and 30, because uninsured motorist only covers the people. 15,000 per person, 30,000 per occurrence for that situation. It doesn't cover the car. At the bottom here, you need the uninsured motorist property damage, which is going to pay you a maximum $3,500 to fix your car because your car is struck by someone who doesn't have insurance and it's their fault. All right. So that's what you got to watch out for. Okay. Now, if you don't have collision, the maximum we're going to pay is $3,500, and that number is going to look familiar when you take your test. Okay. So in California, we do have lower financial responsibility limits than most other states. So if you get the minimum liability limits in California and you travel to another state that has higher limits, well, as long as it's just a visit, your policy will automatically provide the higher limits while you're visiting another state. Okay. Likewise, California, we don't have personal injury protection on our policies. So if you travel to a state that requires that, and you get into an accident in that state, since it's just a visit, you're automatically provided with personal injury protection on your personal auto policy. Okay, so that's how that works. All right. Automobile limits of liability expressed as 25, 50, and 10 mean what? Now, the numbers may change, but the concept stays the same. 25,000 is bodily injury per person. 50,000 is bodily injury for all people in that accident or that occurrence. And 10,000, the third number, is for the property. Now, I'm using a car, like you hit a car, we'll pay up to 10,000 to fix the car that you hit. How about if you drove through someone's living room? We're going to pay a maximum 10,000 to fix their living room that you just drove through. Okay, so again, weigh it out. Is that enough coverage? Talk to your clients. Okay. Now that's the liability section. Now we have the physical damage section, and it's broken down into two parts: collision and other than collision. Now in the real world, a lot of times you'll hear comprehensive coverage. That's the same as other than collision. The test typically use other than collision. So collision, remember, this covers your car. You damage your car. So collision covers your car because you hit something and damaged your car. So you drove into a tree. That's your fault. All right. That means your rates are going to go up. A lot of times for collision, we have higher deductibles. Okay. So because it's your fault, and your rates are going to go up because it was your fault. So other than collision is something hits you. So instead of you driving into a tree, which is a collision claim, a tree falls on your car during a storm. That's an other than collision claim. All right. That's not your fault. Usually lower deductible. Your rates won't go up because it's not your fault. If someone steals your car, that's an other than collision claim. Okay. Someone breaks the window and steals your laptop and the back seat. The window would be covered by other than collision. The laptop would not be covered by your auto policy. Your auto policy, physical damage coverage, only covers anything bolted, welded, nailed, attached to the vehicle, and a laptop is not. That's personal property. That would actually be covered by your homeowner's policy. All right, so keep that separate. So now if you hit an animal, we always say the animal hit you, and so that's going to be an other than collision claim. All right, so if you're driving down the road and a deer runs across your path and you hit it, we always say the deer hit you. So again, lower deductible, your rates don't go up because it's not your fault. Okay. So, all right. Now, transportation expenses. These are optional coverages. Sometimes you might see them even listed as an endorsement on the test. So if your car's in the shop, did you need to get a rent-a-car? Because if you did, we're going to pay you $20 a day for rent-a-car, usually for up to 30 days. You can always get higher limits, but the $20 a day is probably going to show up on your test. Now, if you do get into an accident, right, or there's damage to your vehicle from collision or other than collision, it's usually a 24-hour wait, and then we pay you $20 a day for the rental car. If someone steals your car, theft of a vehicle, there's a 48-hour wait before we pay you the $20 a day for a rental car. Okay. Reason is it might show up. All right. Or you sobered up and remember where you parked, because that does happen also. Okay. So they give you a little more time to hopefully the car shows up first. All right. Towing and roadside assistance, that's a tow truck coming out to your car because it broke down on the freeway. Either give you a jump for your battery, fix a tire, or tow you to the nearest repair shop, and that's about it. Okay, so it doesn't cover repairs, it just covers towing you to the repair shop for them to repair it, and that's out of pocket. Okay, but those are some optional coverages. Damage done by an earthquake to an insured auto is covered by the personal auto policy, and that's actually a true statement if you have other than collision. Earthquake and flood are covered if you have other than collision coverage. Seems kind of funny, but realistically, if your car's in the middle of a field and the ground starts to shake, what damage could really happen to your car? Nothing. That's why earthquake is covered. If it's a flood, we usually have advance notice where they say, hey, you need to evacuate, and that's typically when you get your car out of the area. So it's not as bad as you think. Okay. Although in some areas, yeah, they have flash floods. So But if you have other than collision, right, actually would be covered. Okay. Under a personal auto policy, which of the following is not a collision loss? And when you take the test, you get a lot of nots and excepts, so read them carefully. So which not a collision loss? And like I said earlier, you hit an animal. In this case, you hit a deer. We always say the animal hit you. All right? So it's not your fault. Lower deductible. Your car is fixed or replaced. Okay, so now we talked about liability and physical damage. Now we have to talk about the rating. So for rating liability coverage under Proposition 103, which is a rare question, you might see the Unruh Act. Okay, the most important factor in rating someone for liability is your driving safety record. That's the most important factor. The second most important factor is the number of miles that you drive annually. All right. Watch that one on the test. It's not number of miles you drive to employment. It's number of miles you drive annually that's a factor. And the more you drive, well, the more likely you are to suffer loss. Okay, so the rates go up. Third thing is how many years you've been driving. And the fourth thing would be any other factors like the geographical area you live in. Okay, that's actually a mild factor, but it is a factor. Okay, you live in a metropolitan area, there's more cars on the road, and historically there's more accidents in that area versus you live way out in the outskirts of town where your nearest neighbor's 5 miles away is a cow, fewer accidents out there. So rates vary by geographic location. So for liability, it's based on how you drive. Now, we in California, we just have liability, medical, and uninsured motorists. Some states have personal injury protection, which is kind of the liability medical blend. Some states have no fault laws. No fault sounds kind of good in theory, okay? But we don't have that here in California. So no fault is you have insurance to cover you. Hopefully someone else has insurance to cover them. And then if there's an accident between you two, not a big deal. You have insurance to cover you. Hopefully they have insurance to cover them. You don't blame each other. You have insurance for yourself and you go your separate ways. Okay. The problem is someone hits you. That's okay though, because your insurance covers you. Their insurance covers them. The problem is you now have a claim with your insurance. And when you have a claim, your rates go up for the next 3 years. Okay. And so that's the downside of no fault. Okay. But that's the concept of how you need to understand no fault laws. I'm going to jump ship to tort law. A person can face a claim for legal liability on the basis of all of the following except. You got to watch out for excepts. All right. Tort law includes all the following except. Okay. Tort law or tort is a legal wrong other than a crime or a breach of contract. So tort law doesn't cover crime because that's criminal law. Tort law doesn't cover breach of contract because that's contract law. The biggest area of tort would be negligence. So that's C. Negligence is a type of tort. All right. B, there are intentional torts and there are unintentional torts, and they can actually be covered. And then absolute liability is part of tort law. Absolute liability means the ability actually to hold someone absolutely liable for all losses associated with the situation. Okay. The best, situation where absolute liability exists would be workers' compensation, where employers are responsible for the losses to their employees. So if an employee is injured on the job, it really doesn't matter how or where, right? Unless it's an intentional act or intoxication, it's covered. All right. So holding the employer absolutely liable for all losses by their employees under their employ, that's absolute liability. So, but your test words it again in different ways where you almost don't recognize it. Okay. Let's see. Absolute liability would be where the public demands that those engaging in it be held responsible for it. Okay. Again, you can look at workers' comp. If you have an employee, you are required by law to have workers' comp. Okay, to protect that employee, even if they're part-time employed. Okay. So absolute liability, workers' comp is a good example. It's not the only example. That's the best one I can think of and to pitch out and have people grasp it. Another area would be strict liability. Strict liability would be to hold the manufacturer strictly liable for all losses related to their product. And so you have a toy manufacturer. They manufacture a toy. They sell it at Toys R Us. Well, hopefully you buy it before they go bankrupt. Okay. And so you bought this toy at Toys R Us. and 2 years later it malfunctions and injures your child. Well, you're not going to sue Toys R Us because they didn't manufacture the product. So you're going to hold the manufacturer strictly liable for all losses by their defective product. Okay, so you go directly to the manufacturer, not the distribution chain. Okay, that's kind of how strict liability works. Rating factors for physical damage. So liability is how you drive. Physical damage is what you drive. So we need to know the year, make, and model of the car that you drive. Okay? Nothing else matters for that. See, I don't care that you have 2 tickets when I'm rating you for physical damage because liability is how you drive. Physical damage is what you drive. So a newer model, expensive car, yeah, it costs more for the parts, and that's what we're going to rate you on. So, so let me explain. If you have liability coverage on a Volkswagen Bug and you trade it in for Cadillac Escalade, and all you want is liability coverage, your rates don't change. So even though you went from a less expensive car to a more expensive car, for liability, it doesn't matter. We're not covering the car. See, liability, we're covering you behind the wheel, and whether you're driving the Volkswagen Bug or the Cadillac, it's still you behind the wheel. See, so the rate hasn't changed for liability. But if we're talking about physical damage, yeah, it does cost more to fix the Cadillac than it does a Volkswagen Bug, you see. And so the physical damage section of the policy may change as far as rating, but not the liability section. Okay. There's absolutely no coverage in Mexico. This is what we call a territorial limit. Your personal auto policy covers you anywhere in U.S., Canada, U.S. territories like Guam, but there's absolutely no coverage in Mexico. Another thing is intentional action. Wear and tear is not covered. So mechanical breakdown, that's wear and tear. That's not covered by insurance. Okay, so be wary of that. Cancellations. We have 3 types of cancellations: prorate, short rate, and flat rate. So prorate, or sometimes called pro rata, it doesn't matter who cancels out. For the test, it doesn't matter. In the real world, yeah, it does. But for the test world, let's keep it simple. So let's say you paid annual premium on the policy, right, January through December, and the policy is canceled 9 months into the contract. Under prorate, the insurance company keeps the first 9 months premium because we covered you. We're going to return the remaining 3 months premium because we're not covering you. Okay, this is assuming you paid annual premium. You paid for the whole year. So we keep the 9 months premium because we covered you, so we've earned that. And then we return the 3 months premium that we didn't cover you because we're not covering you, so we have not earned that. So keep the earned, return the unearned. Short rate, again, you paid annual premium. Policy's canceled 9 months into the contract. Well, we, the insurance company, we're still going to keep the first 9 months because we covered you. We're going to return the remaining 3 months premium back to you, but we're going to charge you a fee for leaving us. It could be an overhead expense or a cancellation fee. And so under short rate, as you notice, if you leave us, we're going to shortchange you. So we return the unused premium minus a fee for leaving us. Okay. So that's how you need to know the difference between those two. Now, flat rate, it doesn't matter who cancels and when. Flat rate means we're going to void the contract and refund all the premium, and we pretend like that policy never existed. Right? A lot of times this is called the rescission of the policy. Void the contract, refund all the premium, okay, pretend like it never existed. Possibly because there's possible fraud or material misrepresentation. Right? When we cancel the policy, here's your money back. Thank you very much. Have a nice life. Okay. We don't keep any of it. Okay. All right. So replacing a vehicle, like I said, if you only have liability on a car, you trade it in for another car and you want liability, you don't have to tell the insurance company. You're automatically covered to the end of the policy period. Because remember, for liability, we're not covering the car. We're just covering you. All right. So that's if you replace the car. But if you buy another car, so you have liability on a car, you buy a second car, although you only want liability, now you got to tell us within 14 days. See, in the first scenario, you had one car, you traded in for one car. So there's still only one car. So the risk hasn't changed. The second scenario, you have one car, but then you add another car. So now there's 2 exposures on the road. So the risk has changed. Okay. And that's when you need to notify us about that. That's for liability. For physical damage, if you have liability only and you replace your car or get another car and you want physical damage coverage, well, since you don't have physical damage coverage already, you have to tell us within 4 days. But if you already have physical damage on your policy, whether you trade it in or buy a new car, additional car, since you already have physical damage, you have more time to tell us. You do got to tell us within 14 days. So some of you are familiar with the 30-day rule. If you buy a new car, you have up to 30 days to get insurance. Throw that out the window. That's the real world. And as long as you're more liberal than this 4 or 14-day rule, that's great in the real world. But the test world is you need to know the 4 or 14 days. Okay. So a sampling of the question would be, Dave has an automobile insured by a personal auto policy. He trades in his car and he purchases a new private passenger auto as a replacement vehicle. If he does not notify the insurance company, the liability coverage for his replacement vehicle will apply automatically to the end of the policy because it's only liability. Okay, so no real change. Endorsements. There's no such thing as a motorcycle policy. Right? You'll see the commercials. Hey, get motorcycle coverage. Hey, get a motorcycle policy. Now, there really isn't. It's an auto policy with an endorsement that defines this policy is covering a motorcycle. An endorsement is called the miscellaneous type B endorsement. Okay. I apologize. All right, so it may not be a motorcycle. It could be a dune buggy, could be a golf cart, could be an RV, or it might be an ATV, all-terrain vehicle. So it's an auto policy with an endorsement that says this policy is covering an ATV. Okay. So, yeah. Now this is to cover the ATV, or this is to cover the motorcycle. So if you have auto insurance and you get a motorcycle, and the first week of riding that motorcycle, you didn't tell the insurance company, or even if it's 2 weeks later, you're riding a motorcycle, and then you lay it down and it slides into a parked car because you're trying to avoid someone who just jumped out in the roadway for you. Okay, the motorcycle won't be covered because you didn't tell us you bought a motorcycle. But whatever you hit with the motorcycle would be covered because that's liability. Right? So liability covers you in no matter what vehicle you are if you have that coverage. But if you don't tell us you had a motorcycle, we'll cover what you hit with the motorcycle, but we won't cover the motorcycle. Okay, until you add this coverage on within this time constraints. Named non-owned auto coverage. These are the city dwellers. Right? People live in the city that rely on public transportation. They don't own cars. Okay. However, they borrow their friends' cars or they rent cars for long trips. You can get liability coverage for that situation. They can only get liability coverages because you can't buy insurance on a car you don't own. Okay. Now, occasional use of a vehicle, no problem. That's what we're talking about here. So if you borrow your friend's car, you get into an accident, it's your fault. Well, since it was your friend's car, your friend's insurance is going to be primary. Always keep in mind that occasional use of a vehicle, insurance follows the vehicle. So if you borrow your friend's car, get into an accident, your friend's insurance pays first. Yours will be secondary or excess. Likewise, if your neighbor borrows your car and gets into an accident driving your car to the store, your insurance will be primary, and then your neighbor's insurance will be secondary or excess. Always remember, insurance follows a vehicle, and this is only when it's occasional use of a vehicle. All right. Now, if you have a personal auto policy and you have coverage on your car, and you work for a company, and they give you a company car to use, which is awesome. Right? The problem is that it's not occasional use. This is regular use. Now, your personal auto policy specifically excludes vehicles that are furnished for your regular use. That means if you got into an accident in a company car and your employer didn't provide enough coverage for you, and they sue you for $300,000, your employer only gave you $100,000 of liability on that company car, your policy won't cover it. Because I said your policy specifically excludes coverage for vehicles that are furnished for your regular use. Okay? And so there's no coverage there. But if you buy this endorsement, extended non-owned auto coverage, then you're going to extend coverage to a vehicle that you do not own, but you use regularly. So remember, named non-owned is for people that don't own cars. Extended non-owned is we're extending a car that is furnished for your regular use, like a company car. Now, there's absolutely no coverage in Mexico. However, if you buy the limited Mexico coverage, we'll cover you for up to 25 miles into Mexico. That's from the U.S. border, not the Mexico border, for no more than 10 days. So that is limited. So, yeah, my recommendation is just get the regular Mexico coverage if you go down there. Don't buy the endorsement. All right. So just remember that. So your personal auto policy specifically excludes coverage in Mexico. All right? Because there's two questions. Let me explain it. All right. How far does your auto policy cover you in Mexico? It doesn't. That's one question because it didn't say you had an endorsement. And don't think, well, if you had the endorsement, it would cover you. Well, that's not what the question's asking. It didn't say you had it. It just says, how far does your personal auto policy provide coverage in Mexico? It doesn't. So then there's a different question that says, if someone purchases the Mexico coverage endorsement, how far does it cover them in New Mexico? And then it would be the 25 miles from the U.S. border. Okay. So read the questions carefully. Don't read too much into it because you end up picking a wrong answer. Okay. Take a step back and say, in general, what are they asking? So which of the following best describes a tortfeasor? Someone who is negligent or someone who commits a tort? That's how you want to know that. Okay. So that, all right. So what's the difference between a personal auto policy and an ISO PAP? And realistically, there is no difference. Didn't we say all of our insurance companies get their policy forms from the ISO? So a personal auto policy would be the same as saying an ISO PAP. There's no difference. Okay. There's no difference between a personal auto policy and an unendorsed personal auto policy. See, personal auto policy covers liability, medical, uninsured motorist, and physical damage. Unendorsed means there's no endorsements. That means you bought a stock policy which covers liability, medical, uninsured motorist, and physical damage. So there's really no difference. See, you're studying a personal auto policy in all your training, and then you go take the test, and they put this 3 letters in front of it, ISO PAP. You're like, what the hell's that? We didn't cover that. We only know what a PAP is, right? Personal auto policy. And so it throws you. And I got to be honest with you, that's not even the question. So under personal auto policy, liability covers who? You or them? Well, liability covers them in case you injure them. So under an ISO PAP, liability covers who? You or them? Well, again, it would be them. You see? Under an unendorsed PAP, liability covers who? You or them? Well, it's still them. You see what I mean? And so the ISO in front of the PAP or the unendorsed in front of that PAP means nothing. So when you read the question, just don't even read that part. And by the way, they'll do that with your homeowner's policy too. Under an ISO HO3, under an unendorsed HO5. Just don't read that part. All right? An HO3 or an HO5, keep it that simple. Named insured were people that are named on the policy, like Jack and Jill own a car, so they're named insureds. The first named insured, well, according to my scenario, would be Jack, because I said Jack and Jill own a car. So Jack and Jill are named on the policy. Jack is the first one named. That means Jack is responsible for paying the premium. Jack can cancel the policy. Jack can request changes to the policy. Okay, Jack gets any premium refund. Jack can transfer the policies to someone else with insurance company's written permission. Okay, that's called an assignment, by the way. Okay, so even though they're both named, the first named insured controls it, and you need to know that, especially when we go into the commercial stuff. Okay. Now, an insured is anyone covered by the policy, although not named. So remember, you lent your car to your neighbor to go to the store, and they get into an accident. They're still insured, but they're not named on the policy. Okay? So that's what an insured is, someone who's still covered by the contract, although not named on the contract. Right? I mean, it seems really simple, but this is your test. And when you're taking a test, a lot of people stress out. And when you stress out, you can't think straight, and you get them mixed up. So the repetition of going through my material, you feel more confident because when you take the test, the questions look very similar. If an insurer pays an insured $25,000 in lost wages, $45,000 for physician's visits and hospital costs, and $15,000 for physical therapy treatments, and later finds out that the claim was fraudulent, the insured may be fined as much as $170,000. Now, submission of a fraudulent claim is number 1, a felony. Number 2, up to 5 years in prison per count. Number 3, $150,000 fine or double the value of the fraud, whichever is the larger number. So if you add these 3 numbers up, 25 plus 45 plus 15, that equals 85,000. And then you double it, and that's 170. Well, 170 is more than 150, so 170 would be the fine. Okay. So if it's less than 150, let's say, it's only 25 and 45. Okay. So that equals 70. 70 times 2 is 140. Well, 150 is more than 140, so 150 would be your answer. Okay. So remember, $150,000 fine or double the value of the fraud, whichever is the larger number. Okay. All right. Standard fire policy. Very limited policy. We don't even sell them anymore here in California. But it only covered 3 perils because it's a named peril form: fire, lightning, and removal. Now, removal is more of a situation than a peril. Okay. Let me explain. Lightning strikes your house. A lot of times, lightning causes fire. The first thing you do is get out with your family, the ones you love. And then you call 911. And then what a normal person would do is they're going to remove some of their property out of the house without endangering themselves, maybe put it in the front driveway or the neighbor's yard to protect it from the fire. Okay? That's what we call removal, where your property is being removed to another location and protected from further loss. Okay? So if something happens during removal, it's still covered. Okay? Now, even though this is a named peril policy, during a period of removal, you have all risk coverage. That means as you're taking stuff out of your house and putting in your neighbor's yard, when you run back in and get more stuff, people are stealing the stuff that you brought out. Unavoidable theft during removal is covered by your standard fire policy because it happened during removal. So even though it's a named peril policy that really doesn't include theft, because I don't see theft listed here under these 3 perils, during removal you have all risk coverage, and you actually have that theft coverage for that. Okay? All right. Now, knowing that doesn't cover a whole lot, you can, for a slight additional charge, purchase extended coverages. Now, the extended coverages, or EC, is a package of 7 additional perils. The easiest way to remember it is these acronyms: WARVs. All right, WARVs: windstorm, hail, aircraft rides, vehicle explosion, and smoke. Okay? A lot of times the test will ask you which of the following is not an example of an extended coverage peril. So if you know the 7 perils: windstorm, hail, aircraft rides, vehicle explosion, and smoke, well, then you know that earthquake and flood are not one of those 7, and that's the one you want to pick. Okay? Now, if you buy extended coverages, well, for another slight additional charge, you can add vandalism coverage. Vandalism and malicious mischief would be covered if you added on for additional charge. However, if the property is left vacant or unoccupied for more than 60 days, we will not cover the vandalism loss. See, if no one's watching your house for 60 days, it kind of becomes a target for vandals. The risk increases. The insurance companies do not want to cover it. So they exclude vandalism loss after the property has been vacant or unoccupied for 60 days. Okay. Up until the 60th day, it is covered. But after the 60th day, then it won't be. Okay. Now, this is only a property policy. There's no liability, and there's no theft except the unavoidable theft during removal. So it's an extremely limited policy. To go back in time, this policy got its name from the fact that it's the only policy where the wording is standardized by law. All right. So if you get a hold of the insurance law book or code book, okay, you'll see this whole policy terminology laid out in writing in the California Insurance Code or in the insurance law. Okay. All right. So what perils are insured against under the additional coverages property removed of a homeowner's policy? And it's all perils. Now, if we didn't just cover this, and even though we just covered it, you're kind of looking at this question going, what the hell are they asking? Well, remember I said during removal you have all risk coverage? This is how the test defines it. So during removal, what type of coverage do you have? All risk, open peril, all perils, right? That's how you need to know it. Okay. So again, the test writers are pretty creative in how they present some of the material, where you almost don't even recognize what they're asking. Okay. So you have to go through these questions repetitiously, so as you see this question, you already know which answer to look for, and then you're ready to go take your test. Okay. So on my website, I have sample test questions that are very similar to the test, okay, that you want to go through over and over again. Now, don't memorize them, just get the concepts down, because the verbiage may change, but the concepts don't. All right. So now you got to know the difference between a standard fire policy, which covers fire, lightning, removal, and a dwelling policy basic form, or DP1, which covers fire, lightning, and internal explosion. Okay. So you do get some comparison contrast type questions. So a dwelling policy basic form provides coverage for which of the following? And you need to know that it's fire, lightning, internal explosion. However, one of your other answers will be fire, lightning, removal. And that kind of looks familiar. And it kind of tempts you to pick that one, but don't. A standard fire policy covers fire, lightning, removal. Okay, but again, you may get the question: the standard fire policy provides coverage for which of the following? Make sure you pick fire, lightning, removal. But one of your answers will probably be the fire, lightning, internal explosion. Okay, and so you got to know the difference between the two. Okay. Homeowners. A lot of people get tripped up on this. Okay? There's different types of homeowners policies. HO1 is not sold in California. It's a basic form, so its actual cash value very limited. Okay. And then there's HO2 through HO8. There is no HO7. Okay. HO8 I don't have on this chart, but I'll talk about it on the next screen. Okay. So a homeowner's policy is a package. It's a combination policy. It covers property and liability, and it also has theft, which, as you can see, is included in the bright teal color. Okay. So property has four parts for homeowners: coverage A, B, C, and D. So A is dwelling, B is other structures, C is personal property, D is loss of use. Let's kind of talk about that. Dwelling is the main house. That means the house that you live in. Anything bolted, welded, nailed, attached to the structure, that would be under coverage A. Coverage B would be other structures. That would be a separate garage. That would be your fence. That would be a gazebo out back. Okay, and there's coverage for that. Now, coverage A and coverage B, since they're structures, that's what we call real property. So on the test, you may see that as real property. Those are structures on the premises. Coverage C is personal property. That'd be your personal belongings. That'd be your furniture, your clothes, your pots and pans, your salt and pepper shaker. And under a homeowner's policy, your personal property is covered anywhere in the world up to the full coverage limit of whatever you bought. Okay, that's kind of nice. And coverage D is loss of use. And what that is if your house burns down where this place is uninhabitable, you can't live there, uninhabitable, I should say. This covers the cost of put you up at a hotel till they rebuild your house so you can move back in later. All right. So loss of use of a building. Theft, of course, covers theft. Now, there are some limitations on certain types of theft losses. All right. And then liability. That covers you and your family's actions while you are anywhere in the world, as long as it's not intentional. That means if you travel to Europe, right, you're out on a golf course, right, you swing that ball and you shank it and you hit some guy in the head, put him into a coma. This liability coverage on your homeowner's policy that you bought here covers you in another country, as long as it was accidental. So the theft coverages, as you can see, are basically included in all coverage forms. And your liability coverage is the same on all the policies. And so your exam question may say, which of the following are similar in your homeowner's policy? And it's usually liability and medical. It's the same on all of our homeowners policies. It doesn't matter which one you get. Those coverages are the same. And so then another question will say, in a homeowner's policy, which of the following coverage parts are different? And that would be the property section. So let's start with an HO4. That's a renter's policy. All right, so you're fresh out of high school or college, you graduate, you get kicked out of the house, you got to go rent a place, you're going to get an apartment. So as you know, under an HO4, there's no coverage A or coverage B, because as a renter, you don't own the structure. And under insurable interest, you cannot insure something that you don't own. There's no other structure because you don't own the separate garage or the fence either. All right, but you do want to cover your belongings in someone else's structure. And so there is personal property coverage. Now, as a renter renting the apartment, if the apartment burns down, where are you going to stay? Well, that's loss of use. So we cover the cost to put you up at a hotel till they rebuild that apartment and you can move back in later. Okay. So then we save money, we buy a condo. That's an HO6. Okay. Now, it doesn't matter whether your condo is in the middle of downtown or in a farmland community, a condo is covered by a condo policy, which is an HO6. The difference between HO4 and HO6 is HO6 condo, you actually own the interior walls, the kitchen cabinets, the fixtures, including the bathtub. And so you need some structures coverage. But for a condo, there's no other structures coverage because you don't own the carports. That's usually covered by the condominium association. If you do own a storage shed, we can add it on. Okay, we can add coverage B. It's optional. You still want to cover your belongings, coverage C. And if your condo burns down, you need a place to stay. That's coverage D, loss of use. Right? So then we save up more money, and now we buy a house. When you buy a house, you have an option between HO2, HO3, or HO5. HO2 is good, HO3 is better, but HO5 would be the best if you own a home. So as you can see, HO2, you have broad form coverage on the structure. That means it's named peril coverage on the building, named peril coverage on the other structures, and named coverage perils on your personal property. So HO3 is better because we now give you all risk coverage on the structures, but you still have broad form and named peril coverage on your contents. Okay. And then HO5, you have all risk coverage on the structures and you have all risk coverage on the contents. Okay. And so you need to understand that. So good, better, best. HO2 is good, HO3 is better, HO5 is best. But it doesn't matter which homeowner's policy you get. You notice the liability and theft is the same on all of them. Okay. So make sure you understand that. Some additional coverages, all right? Liability is built in. So if you borrow your neighbor's camera and take it to Europe and you drop it and it shatters, well, we'll give up to $500 for damage to property of others. Right? If you're part of a condominium association or homeowners association, we give you up to $1,000 for loss assessment. In California, this one I can't vouch for other states yet. In California, there is a mandatory endorsement in our homeowners policy, and that's workers' comp. All right, now, every one of these, that means even a renter and a condo, that's a homeowner's policy, and so they include workers' compensation built in. Okay, so yeah, mandatory endorsement in our homeowners policies in California is workers' compensation. All right. Some additional information: if you bought a condo, you can actually use an HO4 or HO6. HO6, of course, is the better one, right? Because it covers the walls, but sometimes you only need an HO4. What I mean by that is if it's a brand new condo that just got built, they're going to have exterior coverage. They're also going to have interior coverage. So you have condominium association coverage covers exteriors, and condominium unit owners coverage covers interiors. So all you need is a HO4 renter's policy to cover your stuff in that condo. But eventually they're going to drop the unit owner's coverage because you want a reduction in your condominium association dues. And so then you want to move it to an HO6 because HO6, you're now responsible for your structures, the interior side of the condo, the kitchen cabinets and the bathtub. Okay. But HO4 or HO6 may be used if you own a condo. HO2 or HO3 can be used to cover a mobile home. Right? In order to cover it, it's got to be at least 10 feet by 40 feet. Right? It must be worth at least $4,000 to be covered. You cannot get an HO5 policy on a mobile home. Okay, so I can't get the flagship homeowners policy on a mobile home. And it's a rare one, but an HO8 is a modified HO1 for older homes. Right? We associate with antique homes. It's very limited. It pays actual cash value on the structure and contents. Okay, so HO8. Whenever time you see HO8, think of antique homes, older homes. All right, so differences in coverage. In a homeowner's policy, which is on the left, we have 4 coverage parts, right? Dwelling, other structures, personal property, and loss of use. But a standard fire policy or dwelling, the property has 5 coverage parts. Dwelling, other structures, personal property. Those A, B, and C are the same on both. But dwelling has coverage D and coverage E, which if you look at coverage D in a homeowner's, it's the same thing. Okay, so don't get bogged down by that. Well, why does dwelling have 5 parts on the property and homeowners has 4? I don't know. I wasn't there when they put these things together. Okay, but realistically, it's the same. All the homeowners policy did was combine coverage D and E from a dwelling policy and call it loss of use. Because D1 is additional living expenses, which is the same as coverage E, and D2 is loss of rental income, which is the same as coverage D on the dwelling policy. So there's really no difference. It's the same. They just break it down differently. So now let's go into dwelling. So homeowners is you own a home. It's owner occupied. You own it, you live in it. Right? Dwelling, think of as a landlord policy. Now dwelling is only property. So at the top we have DP1, which is basic. DP2 is broad, right? And those are both named peril forms. And DP3 is a special form or open peril or all risk. Right? So again, DP1 is good. DP2 is better. DP3 would be the best. Okay. The example would be go to about 2/3 across where it says perils. Right? A DP1 covers fire, lightning, and internal explosion. The DP2 covers those basic perils, those three, plus extended coverages. Remember the windstorm, hail, aircraft riots, vehicle explosion, smoke. The DP2 also covers vandalism and malicious mischief. It also covers falling objects, burglary, collapse, and there's 7 other perils that can be included. Actually, are part of the DP2. All right. So you see, DP1 covers these 3 things. A DP2 covers those plus this. But a DP3 would be the best because it's all risk. That means we have certain exclusions: earthquake, flood, war, military action, nuclear risk, wear and tear, and intentional acts. And if it's not one of those perils, it's covered. Now, the thing about a dwelling policy is it's only property coverage. All right. Now, if you wanted to add liability and theft, that's the bottom right-hand corner of this chart. That's optional. And so you're a landlord, you buy coverage for the structure because you own the building. Did you want theft coverage and liability coverage? We can add it on. All right. Just so you know. All right. Co-insurance. Some of you hate math. I got to be honest with you, at best, maybe 2 to 3 math questions on this test. So even if you suck at math, only 2 or 3 you're going to get wrong. So if you failed it by 2 or 3, don't think it was just the math. It's other topics that you kind of didn't quite have a good grasp on, or didn't quite understand, or misread the question. So yeah, but going through my questions, you'll recognize a lot of stuff. But get this co-insurance equation down. Insurance companies encourage you to carry reasonable amounts of coverage on property. They want you to carry, in most cases for the test, at least 80% of coverage to the value of the property. If you carry less than 80% of coverage to the value of the property, well, then you have to pay more of a claim. And so to calculate that, we have this co-insurance equation. We look at the amount of insurance you did have divided by the amount of insurance you should have had for that property. We take that fraction, we multiply it by the loss, whatever that is. Okay, that's going to tell you how much the insurance company will pay on your claim, and then you have to pay the deductible. Okay, so the claim payment minus any applicable deductible. Sometimes the test will say disregard any deductibles. So let's try a question. We have an apartment house that's worth $500,000. The owner insures it for $300,000. The policy has an 80% coinsurance clause. There's a $200,000 loss. The insurer will pay, well, we don't know. Let's plug in the numbers. So the amount of insurance you did have is $300,000 because that's the coverage you bought. The amount of insurance you should have had is $400,000. You see, there's an 80% coinsurance. And when you see 80% coinsurance, that's how much insurance the insurance company is requiring you to carry, at least how much you should carry. You can always carry more than that, but anything less than 80%, you're going to pay more of a claim. And we'll see that in this example. And so 80% of the value of the building, if the building's worth $500,000, 80% of that would be $400,000. The loss was $200,000. So we take the did, let me go back. The did, right, that's going to be the $300,000 divided by the should, which is $400,000. That actually simplifies to 3/4. 3/4 times the loss of $200,000 is going to tell you how much is going to be paid on the claim, which is $150,000. So 300 divided by 400, right, simplifies to 3/4 times the $200,000 loss, $150,000 of claim payment. It doesn't say anything about a deductible, so we'll disregard that. Okay, so this is kind of funny. So let's say you did have a $1,000 deductible. Because you uninsured, the company is only going to pay $150,000 minus your deductible. So on a $200,000 loss, you have to pay $50,000 plus a deductible because you didn't have enough insurance when you bought the policy. You see, so it's a penalty for underinsuring. So the coinsurance equation, and as you can see, we have a coinsurance penalty because you're underinsured. So cheap isn't always good. Valuation clause. Whenever you see valuation, it means how are we going to pay on a claim? There's different types of valuation. Typically for homes, we were going to cover the home on a replacement cost basis. What does it cost to rebuild this home just like it was before the fire, brand new? Okay. Now all your belongings in the home, like your clothes, your furniture, your pots and pans, your big screen TV, we're going to give you actual cash value basis. That means what would it cost to replace that big screen TV minus depreciation? Okay. And so you don't get the full value. You can get an endorsement, which gives you replacement cost on your personal property. But if you don't have it, you only get actual cash value. All right? So they depreciate it. Market value, a lot of times you'll see used for vehicles, like you total your car. We'll grab a newspaper, find three people selling the same car as the one you just totaled. We take the high, the low, the mid, average it out, because that's what you would have gotten for it, your car if you'd have sold it a day before the accident. You see what I mean? So that's market value. What would it be worth if it were sold? Right? Stated value or value policy. Right? Think of fine arts or antique cars where we put a stated value. And so in a partial loss, we'll pay actual cash value for the damage up to a stated value in the contract. Right? So let me explain. Let's say you have a unique oil painting, very rare oil painting worth $10,000. One third of that painting is destroyed by a fire. Okay, so it's not a total loss because only one third was damaged. But can you really replace one third of an oil painting? Typically not. So we're going to pay actual cash value for the damage up to the value. So in a partial loss, like one third of that oil painting getting damaged because of fire, you can get a full payout. That's a stated value valued policy. All right? And so, but if they do pay you out, they're going to take the painting away. So just so you know. Antique cars is very common also because those antique cars you can't make parts or you can't find parts because they don't make them anymore. Okay, and so there's a stated value. Okay, sometimes you'll see agreed to value on the test, so it's an amount that you and the insurance company agreed to that'll be paid in the event of a loss. Okay, so and all of it's stated in writing in the contract. Fair claims practice. This is how a normal claim should be handled. Number one, client suffers a loss. They need to immediately notify the insurance company. And a lot of times on the test, you'll say immediately in writing. Okay. So notice of loss just means you're letting the insurance company know or the agent know, because they represent the company, that you suffered a loss. The insurance company is going to do three things. Number one, they're going to acknowledge you suffered a loss. Number two, they're going to begin their investigation on the claim and send you claim forms in some cases to help you, put in your information about what loss you suffered. Now, that's going to be called proof of loss, is where you estimate and list the property that was damaged. So then you have to submit your proof of loss within 60 days of the loss. Once the insurance company accepts due proof of loss, they're supposed to pay the claim immediately. Now, unless they notify you that we need a little more time, right? For whatever reason, it's got to be a legitimate reason. Okay, they need to pay the claim immediately. Okay? Usually within 30 days, by the way. Okay. So this is how a normal claim should be handled. If the claim does not follow this process, well, then it could be an example of an unfair claims practice. Okay. Excuse me. So, how about if the insurance company says, "Can you do me a favor? Can you resubmit proof of loss?" Well, when they say resubmit, that means they acknowledge you gave them proof of loss, and so now they're having you resubmit. That's kind of delaying for them to pay the claim. You see what I mean? How about we're not going to pay your claim? You cannot get a premium refund, and by the way, don't get an attorney. You cannot directly advise a claimant not to obtain the services of an attorney. Okay. However, it is fair claims practice if you advise the client to go get an attorney. So it's okay to go tell them go get an attorney, but you can't tell them don't get an attorney. You see? So that would be unfair claims. How about attempting to settle a claim for less than what a normal person would think they would be entitled to? So you bought a brand new Mercedes, you got adequate coverage on the car, you get into an accident, it's totaled, and the insurance company gives you a check for $2,000 because that's all that block of scrap metal is now worth. Oh, no, this is a brand new Mercedes. That's less than what a normal person would think they would get if they damaged a brand new Mercedes. You see what I mean? And so that would be unfair claims practice. Right? So again, if it doesn't follow these guidelines, then it falls under unfair claims practice. For loss settlements, if there is a dispute, you got to know the difference. For liability, we go through arbitration. So the insurance company picks an arbitrator, you pick an arbitrator. These arbitrators basically plead their case to a third arbitrator who hears both sides, like Judge Judy, and makes an ultimate decision. It is binding. Okay. Now that's for liability disputes. If it's a property dispute, well, you get an appraiser, the insurance company gets an appraiser. These two appraisers, they hash it out to an umpire. The umpire hears both sides, like Judge Judy again, and makes a final decision. Okay. So the difference between arbitration and appraisal is the type of loss. Arbitration is for liability disputes. Appraisal is for property disputes. Appraisal, we use an umpire. Arbitration, we use a third arbitrator to hear both sides and make a decision. Okay. All right. Still under tort law, X is in an accident with Y. X suffers $5,000 of damage, but it is determined that Y is 60% responsible for the accident. How much would X receive under contributory negligence rules? And you get nothing. Whenever you see contributory negligence, if you contribute in any way, shape, or form, you collect nothing. Right? So we really don't have contributory negligence rules in California. It was way back in the day, like when workers' comp first started out, we had that. Okay. We typically have comparative negligence. Same question, basically. X is in an accident with Y. X suffers $5,000 of damage, but it is determined that Y is 60% responsible for the accident. How much would X receive under comparative negligence? And it'd be $3,000. And so contributory means you get nothing. Compare means we share. So if X is 40% responsible, they can still collect 60% that Y damaged, right? And that means Y collects 40% from X. You see how they share the claim? So compare, we share. Contributory, 0. All right. So questions look exactly the same except for that one word. So be wary. Some other personal lines coverages. Excess liability, the difference between excess liability and an umbrella is excess liability is additional liability over one line of coverage. And so let's say we have some city dwellers. They live in San Francisco that I know, and they own a home or they rent, but they don't have a car. But, you know, they have pretty good income and some assets where they could be sued and they don't want to give that up. And so we're going to get an excess liability policy. So if someone, if they injure someone, maybe they have a cocktail party, someone slips and falls in the house, and then they sue, and that lawsuit exceeds the liability on the home policy, well, then the excess liability can give them additional $1 million or more of additional liability protection. All right? But it's only on one line of coverage. Now, an umbrella policy, think higher limits, broader coverage. So again, we have a home, but now we have an auto and maybe a boat. Let's start with that. And so an umbrella gives you excess liability over multiple lines. Now, in order to buy an umbrella policy, you got to have a personal liability policy like home, right, or renters, right, and an auto policy, auto liability. So you got to have personal liability and auto liability in order to get an umbrella. So as you can see, it covers more. So if you had a boat and you hit someone with your boat and they sue you and the lawsuit exceeds the liability on your boat owner's policy, your umbrella can kick in and, like I said, give you at least $1 million or more of additional liability coverage. Now, let's say you have a liability exposure that's not covered by the umbrella. Or I'm sorry, it's not covered by an underlying policy. Well, if you pay a self-insured retention, that's over here on the right, bottom right, which is another way of saying deductible. If it's a liability exposure, since it's not covered by a base policy, pay a deductible and the umbrella can still cover that claim. Okay, so self-insured retention is like a deductible for losses that are not covered by an underlying policy, but can still be covered by the umbrella policy. All right. Floaters. Yeah, a lot of you, when you hear floaters or inland marine, you're thinking boats, and it actually has absolutely nothing to do with boats. All right. So I'm going to use jewelry. So your standard homeowner's policy on the bottom left-hand corner here, if someone breaks in and steals all your jewelry, your homeowner's policy gives you a maximum $1,500 for theft of jewelry. So if you have more jewelry than $1,500, but not a lot, let's say no more than $10,000, well, then you get a personal property floater. It can actually cover your jewelry up to, let's say, $10,000. And so your jewelry is, you have more jewelry than the homeowner's policy will afford, but not a lot. And so you get the personal property floater, which is unscheduled. Unscheduled means I don't need a list of all your jewelry. Okay. Just at the time of the loss, you do have to show proof of loss. So then if you have more jewelry than 10,000, I'm plucking at 10,000 out of a tree, by the way. Each company is a little bit different on that threshold, that limit. Okay. But in this case, if you have more than 10,000 in jewelry, well, then you get a personal article floater. Now, this means I need you to schedule your jewelry. That means I need you to give me a list of your jewelry with appraisals so I know how much it's worth. Okay. And so all you're doing is you're getting higher limits of coverage on some high theft items. Okay. Like jewelry, firearms, Firearms, we give you $2,500 on a homeowner's policy if someone steals your guns. Silverware, we give you $2,500 maximum if someone steals your silverware. So if you have more silverware and more firearms, then you can get these floaters to increase the limits of coverage. Now, floaters or inland marine gives you all risk coverage, which is great coverage worldwide. So it covers your personal contents, personal property anywhere in the world at these higher limits. All right. So yeah, in fact, you can pretty much get a floater or inland marine coverage to increase value on pretty much everything you own that are the collectibles, except money. All right. For the test, and a lot of companies in the real world, the maximum you'll ever get for any type of loss to money is $200. Now, I'm not including stamps and coin collections. That's a different world. You can get a floater for those, okay, because they're collectibles. But normal money, the maximum you'll get is $200, whether it burned up in a fire or someone broke in your house and stole all your money that was sitting there. That's all you'll get is $200 for the test, okay? What is a self-insured retention under an umbrella policy? And remember, it's a deductible for losses that are not covered by an underlying policy, but can still be covered by the umbrella policy. All right, boats. There's a couple ways to cover boats. The first one is the watercraft endorsement. So the watercraft endorsement, we can cover your small watercraft, and we're going to add it to your homeowner's policy. Now there's a catch. So if you slipped and fell in your house, and you have a homeowner's policy, you cannot file a claim against your homeowner's policy because the liability coverage and medical is for others like your guests. You should have health insurance for you and your family. So now if you add the boat to your homeowner's policy, it's going to copy your homeowner's policy coverage, which means if you slipped and fell and injured yourself on your own boat, it's not going to cover you. You should have health insurance for that. We only cover liability medical to other people. So it's liability and medical for other people, and the boat has to be, as you see at the bottom, the boat has to be scheduled. Now, whenever you see scheduled, I need a description that it's a 22-foot bass fishing boat with 25 horsepower engine. So I need a list. So the better way to cover that small watercraft is to get a boat owner's policy. So then a boat owner's policy is similar in design to an auto policy. You have liability in case you hit other people. There's medical for you and the passengers in your car, in this case your boat. And there's also physical damage for the boat, which is that collision other than collision, just like your auto policy. Okay? So a boat owner's policy is similar in design to an auto policy. Now, whenever you see boat owners, think of inland rivers and lakes. If you're going in the ocean, now we change it to a yacht policy. And instead of calling it liability and medical, we're going to call it protection and indemnity. Instead of calling it physical damage coverage, we're going to call it hull coverage, which covers the ship itself, the engine, the motor. Okay, that's under hull coverage, including the gasoline. Gasoline would be covered under hull insurance. Okay. Now, if you're actually in the ocean marine business, where import-export using ships, that's the ocean marine coverage. And again, we have protection and indemnity, which covers liability, right? Covers medical for you and your passengers, includes workers' comp for the captain and crew. It covers the hull, which is a ship, but at the bottom right-hand corner also covers the cargo, which is stuff you're transporting, but also covers freight, which covers the shipping charges. So let me explain that. You go to the post office to send a package to someone for their birthday. Send them a birthday gift, okay? And you insure the package, okay? Well, cargo would be the package. And so you bought insurance to insure it, and they lost the package. Not only did you lose the package, you lost the postage that you had to pay to send the package. Well, freight coverage would be reimbursing your postage, okay? So cargo covers the cost for replacing the package, and freight covers reimbursing the shipping costs. Okay, so that's a little bit different. And at the very bottom, again, yacht and ocean marine policies have navigational limits. Remember, land, we have territorial limits, but on the water, we have navigational limits where your policies will not cover you in certain hostile areas. Okay, so that's the personal line side. So let's take a quick stretch here. I think pretty much everyone's self-muted, but I'll open it up if you do have any questions. All right, let me hop in here. Hold on. All right.
I actually had a question.
Okay. Bring it on.
I don't know if this is part of the test, but I was wondering in slide 58,
Mm-hmm.
and a homeowner or renter purchase all risk for their property?
You know, homeowner or renter purchase all risk for the property.
Yeah, for
Okay.
their personal property.
Not for renters. Now you can
You can't.
purchase. Okay, so now no, because it's a broad form policy. As you can see right here, there's broad form coverage. Okay.
Mhm.
Now you can purchase replacement cost though, instead of actual
Okay.
cash value for personal property. That's an endorsement. Okay.
Okay.
Now, okay, so now there's a little more to your story here, by the way. Okay. Now, an HO3, as you see, it gives you broad form coverage on your personal property, but HO5 gives you all risk coverage on your personal property.
Mhm.
Okay. Now, what you're probably talking about, there's an endorsement called an HO15. If you add an HO15 to an HO3, it's going to be the same coverage as if you had an HO5. In fact, sometimes HO5 is called an HO3 plus an HO15 endorsement. So if that's the case, then yes, if you take an HO4 and you add the HO15, it could change your personal property to all risk coverage. Okay.
Okay.
Does that make sense? So
It does.
I really haven't seen that added to a renter's policy. Where it really comes into play is adding it to an HO3. Okay. So sometimes you'll see HO5 or sometimes you'll see HO3 plus HO15 endorsement. It's the same thing. Okay. Does that help out?
It does. Thank you.
Okay.
I'm also sorry. I was just wondering. I came across some of your materials, and I didn't know what advertising injury was. I don't know.
Oh, that's for commercial.
Okay.
All right. So let's say you have a company and you advertise and you kind of make some false statements in your advertisement where your competitors are injured financially by it. They're losing sales because of it. And so they're going to sue you because you falsified some stuff or you made some untrue statements. Okay.
Okay.
And as long as it was unintentional, it could be covered by your commercial general liability policy.
Okay. So it actually
And
what it.
Yeah, to be more specific, it's actually Part B of your commercial general liability policy. Part A would be bodily injury, property damage to others. Part B is personal and advertising injury to others. And then Part C would be medical to others. That'd be the breakdown of your CL, or commercial general liability.
Okay.
Okay.
Thank you.
All right. Any other questions out there?
Yes, Lauren, I know it's going to come up later, but for the commercial general liability versus the business policy, one of them is has an indefinite time to file a claim. Which one would that be?
That would be the supplemental extended reporting. Okay. And that's additional charge. You actually have to buy that. They're going to offer you to the end of the policy or within the first 60 days after coverage ends. And it just makes the claims reporting period an unlimited period of time. Now, that's usually added to a claims made policy form. Remember, your commercial general liability, you have two ways of writing it, occurrence made and claims made. And your extended reporting periods are on the claims made policies.
Okay. Thank you.
Okay. You got it. And I have a chart here, and again, if you register for my material, I actually have some of the charts in here that I'm using in this presentation on my website for you to access anytime. Okay. So, all right.
Oh, just one last thing. Right at the very end, I was just gonna ask you about the valuation clause. At the very end, you made the correlation between stated and agreed. Guys, if you're
agreed to value.
Throw agreed in there. He gave it to us, and you're gonna need it.
Yeah. Okay. I'll do that. I can do that. No problem. So good. Yeah. So the loss is already agreed upon at the onset of the policy is what that is. So, all right. Cool. Good feedback. Thank you. All right. Any other questions there? All right. Let's continue then. All right. Good. All right. Personal versus commercial. This is kind of a real quick summary. I mean, I've got another one coming up. But homeowners is a package. And me, I like eating. I'm a foodie, but I'm a chain foodie. Um, so homeowners, think of going to a restaurant and it covers property theft and liability. So think of getting I don't know, let's go with a burger, fries, and a shake. How's that? That's a combo plate. All right. Now dwelling is going to that restaurant and just having a burger. See the fries and the shake? That's optional. Okay. So homeowners know that it's a self-contained package policy. Dwelling is just eating off an a la carte menu. You get the burger, and then the fries and the shake are optional. And some other optional coverages on a home, like a warranty. Now, a home warranty is not on your exam. But when you buy a new house, they're going to offer you a home warranty, to where, in case your dishwasher breaks down, washing machine breaks down, there's some plumbing or electrical problem, you pay a deductible and someone comes out and fixes it. Okay, that's what a home warranty is about. Not on your exam. That's why it's in red here. All right. But I kind of want you to understand the concept of it. All right? Because in commercial, we have kind of something similar to that. And so for dwelling, also as a landlord, you might want that coverage also because you have a washing machine and dryer and it could break down. Okay. The floaters, remember the inland marine coverages, covers your jewelry, watches, furs, firearms, and silverware at higher limits. Okay. That can be added on to the home and or the dwelling. All right. And then you have your auto policy, which we talked about personal auto policy at the beginning of the presentation. So now a homeowner's policy is for 1 to 2 living units. So a single family home or a duplex. Maybe you own 2 homes. Okay. And then dwelling is it's non-owner occupied, right? Or up to 4 units. So 1 to 4 units. So if you own a house and you don't live there, you rent it out to someone else, you cannot buy a homeowner's policy because homeowners, you own it and you occupy it. It means you got to live there. So if you own a house and you don't live there, you got to go to dwelling. Homeowners is only 1 to 2 units. And so either you have 1 home or you have 2 homes. You live in one, your sister lives in another home. You can buy a homeowner's policy for those 2 homes. If it's more than 2, then you go to dwelling. Dwelling is 1 to 4 units. Okay, so let's say you own a fourplex or you own 4 homes. You live in one, your sister lives in another. But if your brother lives in a third one, sorry, we got to go to dwelling because homeowners is only 1 to 2 units. Okay, now dwelling is 1 to 4 units. If it's larger than 4 units, then you go to a business owner's policy. A business owner policy covers up to 6 stories high, 100,000 square feet, and up to 3 million in annual sales. Now, a business owner is like a homeowner's. It's a self-contained package, covers property and liability. Theft is optional. So when you hear business owner policy, think of a mom and pop shop. I don't know, maybe like a dollar store, right? And maybe you don't want the theft coverage because, I mean, it's only $1, right? So, but it's optional. Okay. Now, instead of a home warranty like over here, for a business, we call it boiler and machinery coverage, sometimes called equipment breakdown coverage. Explosion of steam pipes, steam boilers, turbines, and things like that that aren't covered anywhere else. Okay, kind of like your home warranty. If something breaks down, we come in and fix it. Okay, but that's for business. So if it's a package for a small business, and then we go to an a la carte for a large business, just like a dwelling policy. So if you own a business, own a company, well, let's start with property, right? If you own a building, someone could steal your stuff. Instead of theft, we call it crime. Crime, right? Can you speak right? You have liability because someone could slip and fall on your property over here. Well, someone could slip and fall in the lobby of our company. You have a home warranty to cover your appliances. Well, I have boiler machinery to cover my generators, steam turbines, right? You have floaters to give you increased limits on, high theft items like jewelry, watches, furs. Well, for business, we have inland marine coverage, giving us better coverage on our expensive items like mobile equipment, like a bulldozer, or maybe it's a jewelry store and they want increased limits. That's inland marine. Marine has nothing to do with boats here. Okay? Inland marine covers goods in transit, but it's inland. It doesn't go over ocean. Okay? You have a vehicle used around the house or in the car, in your dwelling to get around town, whatever, go to work. Well, we may have autos used in our business. So commercial auto coverage. So all the coverages, as you can see on the personal line side, we have the same coverages for a business. We just call it a slightly different name, like theft here and crime over here. Home warranty over here, boiler machinery here. Floaters over here, inland marine over here. But the concepts are still basically the same. And so that's what we're going to dive into. Okay. So this next one, again, homeowners, again, 1 to 2 units, must be owner occupied. That means you own it, you live in it. Right? So we talked about the coverages A, B, C, and D. Theft and liability are included. Remember, in California, workers' comp is mandatory, and there's that home warranty. Right? So if it's larger than 2 units, then you go to dwelling. Remember, dwelling is only the property coverage, right? 1 to 4 units may or may not be owner occupied. So a lot of times, again, you get those comparison contrast questions on your exam. You would buy a homeowner's policy instead of dwelling for which of the following reasons? Well, because you want broader coverage. Okay, well, you buy dwelling instead of homeowners for what reason? You don't live there. You see, so those are some of the questions you're typically going to get. So now a business owner policy, like I said, is like a homeowner's policy, right? Covers property, right? Section 1 is property, right? Section 2 is liability. Over here you have theft. Well, over here theft is optional. Because remember, that mom and pop thrift store, it's not going to hurt them to replace simple stuff. It's an option. Okay. You have a home warranty for your house. Well, we got boiler machinery for our business, right? Because our little 7-Eleven store, we have those coolers to keep the ice cream cool for the hot weather. You see what I mean? In case something breaks down, we need to have someone come out and fix it. That type of thing. Okay. So a business owner policy, again, here it is, up to 6 stories, up to 100,000 square feet, and no more than $3 million in annual sales. So multiplex cinemas cannot be covered under a business owner policy. Multiplex cinemas do more than $3 million a year. Financial institutions like banks, credit unions, they do more than $3 million a year. Jewelry stores, auto repair shops are too specialized to be covered under a business owner policy. So when you hear a business owner policy, just think of a mom and pop general store. I'd almost equate that to like a Subway restaurant. Because a good Subway restaurant does about $1 million a year, okay? And they don't serve alcohol. Because if they serve alcohol, then we want to go to commercial, at least for the test. In the real world, some of your companies offer, restaurant coverage to small businesses under a business owner policy, okay? And it includes alcohol. But for the test, keep that separate. All right. So now we go to dwelling. Remember, 1 to 4 units, because it's larger than 2 units. Remember, homeowners 1 to 2. So we go to dwelling if it's larger than that. And a business owner policy is up to 6 stories. So if it's larger than that, then we go to commercial property, right? Part of the package policy. Okay. Now again, monoline is you bought a single line of coverage. Like commercial auto is typically sold as a monoline policy. So if you have 2 or more coverage parts, which we're going to get into these coverage parts over here, okay, 2 or more would be part of a package or modular policy. Don't get tripped up by the terminology the exam uses. They're different modules. So property coverage is a module. All right. So jumping into commercial property, we have 4 causal loss forms. Basic, broad, and earthquake are named peril forms, and special, of course, is all risk. All right. I'm not going to dive too heavily into this. I do have another webinar on my site, on YouTube, I should say, and I go specifically into commercial property. I'm about ready to post my commercial general liability webinar this week also. So I'm kind of slowly breaking down each section and giving you a lot more detail in each section for the commercial part. So now for commercial property coverage, it's actual cash value on everything. Actual cash value on the building, actual cash value on your stuff in the building. Okay. But it only covers property if it's in and around within 100 feet of the premises. All right. So property off premises isn't going to be covered by your commercial property policy. That means your goods in transit, that would be covered by inland marine coverage because the property has left the building and is in transit. That's type of inland marine coverage, okay, on land. Companies want that 80% coinsurance because if you have that 80% coinsurance, you get those extensions, okay, which again, $250,000 for a newly acquired or constructed property, $100,000 for contents in that newly acquired or constructed property. And there's a couple other. Again, so check out that commercial property webinar. It's a lot shorter than this one, okay? So it's got quite a bit of stuff here, okay? Under an unendorsed. Remember, don't even read unendorsed. Unendorsed means you don't have endorsements. You just bought a commercial property coverage form. So under a commercial property coverage form with no optional coverages, which is redundant, what basis are buildings valued? And remember, under commercial property, everything is actual cash value. All right? One example of a loss covered by business income insurance is a loss of profits. So if a restaurant closes down because of a fire, business income replaces the lost income that they would have earned if they were open for business. Now, business income has a 72-hour deductible. That means if a restaurant closes because of a fire, they still have to wait 3 days before the insurance company starts paying them missing revenues that they would have normally earned if they were open for business. Okay. So if a property owner is insured under a building and personal property insurance form, when is the property considered vacant? Well, if you own a building, we, the insurance company, would consider it vacant if 70% of the building is empty. Now, instead of saying 70% of the building is empty, the question says, or the answer says, less than 31% is in use. You see how there's another way of saying 70% empty by saying less than 31% is being used. So again, you're focused on studying one way, and test gives you stuff on the other side of the coin. And so you've got to be in tune to that. You got to watch out for that. Now, remember, this is if you own the building, all right? But how about if you're a tenant leasing space in the building? Now, you have a different definition for vacancy, okay? And your definition is you don't have enough business personal property to run your business, okay? So owner of the building, vacancy means 70% is empty, but leasing space in the building, your definition of vacancy is you don't have enough business personal property to run a business. Okay, so two different definitions depending on whether you're the owner or a tenant or leasing space in the building. So watch out for that. So Thomas Fries insured a building under his commercial policy. The building was vacant for 70 consecutive days before a loss. The policy will not pay for loss if caused by perils of glass breakage and vandalism. Okay, so if the property is vacant for more than 60 days, we are not going to cover vandalism, glass breakage, sprinkler leakage, water damage, and theft or attempted theft. So there's 5 specific perils that we will not cover after 60 days of a commercial property being vacant. Okay, and this is an example of it. Okay, all right. Crime coverage. So again, remember, for homeowners and dwelling, we call it theft coverage. For a business, it's called crime coverage. And so we have 4 main coverage parts. There's actually a lot more than this, but these are the coverage parts you want to know for your exam. And notice that coverage A is employee dishonesty. And so you're going to typically get a test question: which of the following policies covers employee dishonesty? And now I really, really want you to first look for fidelity bond, because honestly, a fidelity bond covers employee dishonesty, but you may not get that as an answer. So then your next best guess is go for commercial crime coverage, because Part A is basically a fidelity bond within the crime policy. And so, so employee dishonesty is covered by your commercial crime policy. Now, forgery or alteration, that means some outside party got into your company vault, took your checks and money orders, forged and altered them, and sent them out to other people. Okay, now that's an outside party. See, because if your employees took your money orders and checks and forged and altered them, sent them out, that would be coverage A. Employee was dishonest, employee dishonesty. Coverage C is theft of money and securities from an outside party, because if your employee stole your money and securities, that would actually be covered under coverage A because your employee was dishonest. You see? And then coverage D is theft of your inventory from outside parties, because if your employees were stealing your inventory, catch the picture, it's under coverage A. Your employee did something dishonest. So coverage A is employees doing something wrong, and coverage B, C, and D is other people doing something wrong to your company. Okay, you do get definition questions on this section. Theft is defined as any act of stealing. Theft has the broadest definition. So theft includes burglary, theft includes robbery, theft includes safe burglary. They're all types of theft in different variations. So burglary. So you have a closed room, someone kicks in the door and steals your stuff, and you have burglary coverage. And burglary coverage would only cover the damage to the door. So burglary is defined as visible marks of forcible entry. That's what burglary coverage. So the stuff that they stole would not be covered unless you had theft coverage along with the burglary coverage. You see? So remember, keep the definitions separate and distinct. Uh, Robbery. Okay, so remember, burglary. There's no one there. Someone kicked in, or they broke into closed premises. Robbery is someone is there. They're threatening to injure or murder them and take property from them. That's robbery when someone is being threatened. Okay. Safe burglary. You see in the movies, they kind of move that picture frame out of the way, and there's a wall safe. That would be safe burglary, breaking into a safe. Okay. So you got to know the difference, right? Again, you do get some definitions on this test. Messenger versus custodian. So I'm still in my office, and let's say I give one of my staff people my bank deposit. Now, while they're holding the bank deposit in their hands in the building, they're called a custodian. They have possession of company property on premises. Once they leave the building, they hop in their car and they drive to the bank. They now become a messenger, possession of company property away from the location of the business. Okay, so remember, anything in and around the building within 100 feet of the premises, all right, would be on premises. That would be a custodian. Once they leave and exceed that 100 feet from the premises, they become a messenger. By the way, a messenger can also be an armored car transport service. They have possession of your company property away from the location of the business. Okay. Commercial general liability. There you go. Bodily injury and property damage to others. Personal and advertising injury to others, and medical payments to others. So this doesn't cover you, the owner of the company. This doesn't even cover you, the employees, because employees are covered under workers' comp, and you, the owner of the company, you should have health insurance. Okay, this is for your customers, which are third parties. All right. Now, if your employee injures a customer, your liability covers injury to the customer. If your employee is injured, that's workers' comp. But you, as an employer, are responsible for the actions of your employees. That's called vicarious liability, where you are responsible for the actions of another. So those of you that have small children, your kid throws a rock through your neighbor's window, you're liable because that's vicarious liability. You were responsible for the actions of your children. Okay. So, so again, in a business, the owners and employees are first parties, and remember, liability covers third parties, the customer. Okay, get that down. I think it's tricky. Now, under a commercial general liability or GL, all right, general liability, there's an aggregate limit. The general aggregate limit covers losses on the location of the business. So premises, that means a slip and fall in the lobby. Now, that's the general aggregate limit on the policy. Let me define aggregate limit. Aggregate limit is defined as the maximum that your policy will pay for all claims during a policy period. Okay? And so let's say your aggregate limit is 1 million. That means we cover all these little claims until we paid 1 million during the policy period. Once we paid 1 million in claims, if there's any other claims that come in during the rest of that policy period, sorry, you used up your insurance, so now you're going to have to cover the rest out of your pocket. Okay? That's an aggregate limit. Now, the general aggregate limit covers the location, and it does not include, there's a separate aggregate limit for products and completed operations, and this covers losses that occur away from the location of the business. And so let's say you're a toy manufacturer, okay, and you have a tour where people come through your toy factory and someone slips and falls. That would be the premises and operations aggregate limit, okay, because they got injured on the premises. Now, let's say someone bought a toy, they took it home, 2 years later it malfunctions and stabs them in their leg. That loss occurred away from the location of the business. So that would be covered under the products and completed operations aggregate limit, which is a separate limit. Okay. To be honest with you, pretty much all your policies only have one aggregate limit, but your CGL can actually have up to 6. Okay. The two that you're typically tested on are these two, premises and operations, and then products and completed operations, right? So your commercial general liability covers liability associated with mobile equipment. When I say mobile equipment, think of like a forklift, a bulldozer, a Zamboni. If you don't know what a Zamboni is, it's that machine that cleans that top sheet of ice on an ice rink, okay? You normally would not drive that on a freeway. That's what we call mobile equipment, non-street legal vehicles, like a forklift. It's used to, put around a warehouse, not really drive on a freeway. Okay, And so that's mobile equipment. So inland marine covers the forklift if it's damaged, right? Uh, but the liability covers what you hit with the forklift. If you drove across the parking lot to your neighbor's company and drove into their lobby with a forklift, accidentally, by the way, okay, then that would be liability because you damaged someone else's property. So the exclusions on your commercial general liability would be professional liability. So doctors are covered by malpractice, which is a type of professional liability in case they make a mistake. Agents and brokers are covered by errors and omissions, which is a type of professional liability also. Directors and officers coverage covers, mismanagement of a company. And employment practices liability covers sexual harassment, unfair discrimination claims. Okay, those are types of professional liability coverages. Now, professional liability coverage covers the individual versus general liability covers the business. And so that's got to keep it separate. That's why they're separate. Your commercial general liability does not cover aircraft because then you need aircraft coverage, right? That's what's cool about this industry. A lot of times it's pretty straightforward. What covers aircraft? Aircraft coverage. What covers auto? Auto coverage. Okay. Keep it simple that way. And your commercial general liability does not cover businesses that are in the alcohol business. So if you're a restaurant and you serve alcohol, the CGL doesn't cover that. Now you can get the liquor liability endorsement. Okay. That's additional. That's optional. And it's very expensive. However, your commercial general liability covers what's called host liquor liability. So host liquor liability is occasional liquor use by a company. All right. So occasional liquor use by a company. So let's say it's a real estate office and we have a quarterly kickoff meeting and we're going to serve alcohol to celebrate. That's covered because you're not in the alcohol business. You're just using it for an event. Okay. So keep that separate. Excuse me. All right. So coverages A and or B of the commercial general liability contract contain coverage for advertising injury. Remember, Part A is bodily injury, property damage. Part B is personal and advertising injury. Which of the following is listed on a commercial general liability declarations as an aggregate limit? Well, that would be the products and completed operations limit. Another way of saying this question, by the way, is this one. The commercial general liability deck page displays many different limits. One limit is shown in the general aggregate limit. Which of the following is the correct statement? That aggregate limit does not include the products and completed operations aggregate limit. Remember, that's a separate aggregate limit. Okay, so yeah, once you get it down that there's two parts to that, okay, then it makes it a lot easier. The advertising injury question, here you go. The JAE Computer Company is being sued by Stack Computer Company for an advertising campaign. Stack Computer feels is false and misleading. If JAE Computer Company would find coverage for losses which could result from this lawsuit under which category of insurance? And that would be your commercial general liability. More specifically, Part B of your commercial general liability policy. Okay. Inland marine, just like your floaters on the personal lines, except this is just for a business, giving you higher limits of coverage and covering things that aren't typically covered. Accounts receivable coverage. If you as a business lost your accounts receivable file, that means you don't know who owes you money, when it's due, and how much they owe you. And so after a fire loss, it'd be kind of cool to have this because they can actually reconstruct your accounts receivable file so you can collect from the people that owe you. Okay, that's what that's about. Even though it says contractors equipment coverage, when you see equipment, think of mobile equipment. And so you have a contractor using a bulldozer, okay? And so we're going to cover that bulldozer. Remember, we don't cover what you hit with the bulldozer. That's liability. We're just covering the bulldozer. Now, when you see equipment dealers coverage, when you see equipment, think of mobile equipment. Dealers means we're selling, okay? So we're selling bulldozers or we're selling forklifts. That's what that coverage is about. Camera and musical instrument dealers coverage, again, means we're selling cameras and or we're selling musical instruments, okay, which are pretty expensive items. All right, that's why you need inland marine to raise coverage and give you better, higher limits of coverage. So camera and musical instrument dealers coverage is we're selling cameras and musical instruments, but commercial articles coverage is kind of hidden. We're actually using cameras or we're using musical instruments in the business. So camera dealers coverage is we're selling cameras, but commercial articles coverage is a photography studio that's using cameras. There's a difference. Jeweler's block gives you better coverage on your jewelry that you're selling, your expensive items, but also covers your customers' jewelry. So when you see inland marine, keep an eye out for the 3 C's: care, custody, and control of other people's property. So someone drops off their ring at your jewelry shop to get cleaned, resized, refitted, maybe change a stone out, and they come back 2 weeks later and the jewelry store burnt down with their ring in it. Okay, inland marine covers customers' property under your care, custody, and control. Okay, that's how that works. Theatrical property coverage covers things used on a set, like scenery, props, costume jewelry. Vehicles can also be covered, but only if they're used on this set. Okay. Furriers, I don't have that here, but furriers would be you're selling fur coats or people bringing their fur coats for cleaning. Okay. So just think of expensive items, manuscripts, maps, drawings as part of valuable papers and records coverage, which is another type of inland marine coverage. I mean, there's all kinds, but just think of expensive items, not your normal stuff. Okay. All right. So where would an insured find coverage to protect against damage to a shipment of televisions shipped on a semi truck? So inland marine covers goods in transit. So remember, your commercial property covers the televisions when they're in and around the building within 100 feet of the premises. Your commercial auto covers the truck, but inland marine covers your televisions that are being shipped on the truck. All right. Again, think of it covers goods in transit, although sometimes inland marine covers stuff that never leaves the premises. Okay. Commercial auto, just like personal auto, covers vehicles used in the course of a business. Right? To know the difference of coverage on each vehicle, we have symbols. Now, there's like over 60 different symbols. Typically, you just need to know these. All right. Symbol, let's start with 9, because some people have a tough time remembering this. An easy way to remember it: symbol 9. 9 begins with the letter N. N for 9, N for non-owned autos. Symbol number 7. 7 begins with S. S for 7. S for specifically described autos. Number 5 begins with F for 5. F for states that have no fault laws. Now this showed up here in California. We're not a no fault state, but apparently this question popped up on the exam, even though that doesn't apply here. Okay. 4, I joke around. I'm ebonically challenged. Now I say faux, so faux owned autos. Just drag it out. Faux owned autos, other than private passenger autos. Okay. Yeah, you're probably gonna laugh when you see that on the test, because it'll help you. It's stupid, but it'll help you remember it. Okay. And then symbol number 1 is the first number of the numeric system, and A is the first letter of the alphabet. So think first number 1. Think of first letter A, which is any auto, which is the most comprehensive symbol, by the way. Okay. Those are the main ones you need to know. Some definitions: owned autos are autos that the company owns. Non-owned autos would be employees using their own cars, because we, the company, don't own them. A hired auto is we, the company, rent a car to use in our business. And so let's take a look at pizza delivery. See, Round Table Pizza, they have their own delivery trucks. Those are owned autos. Domino's, the employees use their own cars to deliver pizza. That's a non-owned auto. So let's say the Round Table Pizza delivery guy walks to work because there's a truck at the work to deliver pizza. And when they get to work, the truck broke down. So now they have to rent a car to deliver the pizza. That's the hired auto. Okay. Now, if I have a company and I give my executives a company car, my commercial auto policy covers them using the company car for business, non-business use, which is great. It only covers that car that I gave them to use. So let's say my executive goes out of town to somewhere in the Midwest to go to a convention to learn some more information for my company. And when they go to this convention in another state, they rent a car. Well, my commercial auto policy only covers the car that I gave them to use. It doesn't cover them going out and renting another car. But as a gesture of goodwill, because I love my people, I'm going to purchase this drive other car coverage, which can extend coverage to a car that my executive rents to go to a convention or rents while on vacation. How's that? So we're extending coverage to another vehicle that they use. Okay. Any type of company or business that uses your car, takes it on a test ride, or they own a parking structure or parking lot where they drive your car like valet, needs garage keepers legal liability coverage. This is the only coverage it covers the business driving customers' cars, and there's a collision claim, damage to the customer's car. That's what garage keepers coverage is all about. So a common test question is, I mean, the name may change, but Sally owns a parking garage, and what type of coverage does Sally have? Garage keepers coverage. Okay. Boiler machinery. All right. This is just like your home warranty. Sometimes it's called equipment breakdown coverage. It's all risk coverage. Now remember, your commercial property policy is named peril. Okay. Um, but I'm sorry. It could actually no scratch that. I'm jumping ahead. Your commercial property policy pays actual cash value. Sorry. Boiler machinery pays replacement costs. Okay. So even though you have a commercial property policy, it pays actual cash value on everything. Boiler machinery gives you replacement costs. Most of your premium for boiler machinery goes towards inspections to prevent and protect against loss. So if you do inspections, replace out some worn out fittings, it can keep from a catastrophic explosion occurring. Okay. Since it's written as all risk, whenever you see all risk or open peril, pay attention to the exclusions. Wear and tear, like I said, is never covered by insurance. The problem is when you take the test, it doesn't say wear and tear. It says inherent defect. Okay, so tools have a tendency to wear out and need to be replaced. That's what's called an inherent defect. And that's not covered by insurance because that's the way of saying wear and tear. Okay. For ocean marine, instead of saying inherent defect, they call it inherent vice. Okay, something that has a tendency to self-destruct. So fruits and vegetables during an extended shipment have a tendency to spoil, and so that's an inherent vice, and that's excluded by insurance because it's just another way of saying wear and tear. Okay, again, Tesco's crazy with some of this terminology, folks. Farm is a blend of residential and commercial in one policy because not only do you live there, you also work there. Okay. And so just like our other coverages, the companies want you to carry at least 80% of coverage to the value of the buildings. Okay. Farm equipment can actually be covered by the farm policy. That would be the tractor. That would be the combine, the non-street legal equipment, because Farmer John's truck that he drives to the store to get groceries is actually covered by Farmer John's auto policy. Okay. There's farm liability. Can be actually part of the program. Livestock coverage can be added, right? In case you had a suicidal cow that hit a car. Farmer John's liability covers the damage that their cow did to your car. But now we got to replace that cow because it took itself out. And so that's livestock coverage, kind of replacing livestock because of a covered peril. Crop insurance is usually provided through the federal government. The federal government steps in where private insurance companies cannot handle the catastrophic loss. So that's why national flood is covered by the feds. Nuclear risk liability is actually provided by the federal government. Federal crop, federal crime. Again, they're federal programs. Workers' compensation is a state program. Okay. So you may get a question that says, which of the following is not a federal program? Workers' compensation is not a federal program. Even though we do have some federal workers' comp programs out there, in general, it's a state regulated program. Each state's slightly different. Okay. Bonds. Bonds are not insurance. Bonds are financial guarantees. There are always three parties to a bond: the obligee, the principal, and the guarantor. The guarantor is also called the insurance company or sometimes called the surety. Any bond and every bond they're designed to protect the obligee. Okay. And then there's a principal, and the principal has to do something. Okay. And if the principal doesn't do something, then the guarantor insurance company pays the obligee. So let's start with a fidelity bond. So you're an employer, you own a business, and you want to protect yourself in case your employee steals from you. So you're going to run out and buy a fidelity bond. Lo and behold, one of your employees steals from you. Number one, you're going to fire them. Number two, you file a claim with your bond. The insurance company is going to pay you what that employee stole from you. So you don't have to miss work and miss pay and try to sue the employee or ex-employee to recover what they stole from you. We, the company, we go ahead and we take care of it. We pay you so you can go on about your business. And then we, the insurance company, then take over the claim and go after the dishonest employee to recover what we already paid you, plus interest and legal fees. Okay, there should never be a loss to bonds because whatever we pay you, the employer, we're going to go after that dishonest employee and recover it from them. Okay, to be honest with you, bonds are subrogation contracts. Okay, subrogation. Someone without insurance loses control, drives through your living room or your house. Okay, and they don't have a job. It's a used car the parents gave them when they kicked them out of the house. Right? No insurance. Maybe they have a part-time job at McDonald's. How's that? And so you sue them, and you're going to win because clearly their car's parked in your living room. All right? But they only have a part-time job at McDonald's, and the judge orders them to pay you $50 a month until the debt's paid because that's all they can afford. Now, $50 a month, how many years do you have to wait to save up enough money to put a deposit on a contractor to rebuild your living room? A long time. So, but you have a homeowner's policy. And that homeowner's policy has a peril called vehicles. So if a vehicle damages your house, that person doesn't have insurance, you pay your deductible. We, the insurance company, cover the cost to rebuild your house, and then we take over the claim and go after that uninsured motorist to recover what we advanced you. Okay, so that's how subrogation works, and bonds are subrogation contracts. The only difference here between a fidelity bond and a surety bond is who pays a premium. With a fidelity bond, the obligee pays a premium, and with a surety bond, the contractor pays a premium. But the concepts are basically the same. Okay. All right. This is a big page. A lot of people trip up on this one. There's two ways of writing commercial general liability, which is the left side. There's two ways of writing commercial crime coverage, which is the right side. And so these items are going to be your answers: occurrence made, claims made, loss sustained, and discovery form. So to keep it simple, let's start off with that. If the test question says liability, bodily injury, property damage, your answer is between occurrence made and claims made. You can eliminate the other two answers, loss sustained and discovery, because it says liability in the question. And again, occurrence made, claims made is how we write liability. So if these four are your answers, you get another question and it says crime or theft or something like that. Well, now your answer is between loss sustained and discovery form, because that's how we write crime coverage. You could eliminate 50% of your answers just by knowing that. Now let's keep these four as your answer. If you get a question that says extended reporting period or retroactive date, now your answer is between claims made and discovery form, okay? Because those two have retroactive dates and extended reporting periods. Occurrence made, loss sustained do not. So again, by knowing this chart, you can pretty much eliminate 50% of your answers. Okay. Now there is one question, which if you sign up for my course, it's in exam 2. I think it's in the first 10 questions. It doesn't say anything. It just says you have up to 1 year to file a claim. And if you ever see you have up to 1 year to file a claim, your answer is loss sustained, because you can see right under here it says up to 1 year to file a claim. Okay. So, and that's how you need to understand that. All right. So now, the easiest way that I can explain this is occurrence made and loss sustained. Let's start with the two on the top. Okay. One's for liability, one's for crime. So the way that we write this and manage this is the same way we write and manage auto insurance. You get into an auto accident today. All right. Tomorrow, your policy renews. Now, you either renew it with the same company or you renew it and go to another company. And then Monday, you file your claim. Which policy is going to cover your auto accident that you had today? The policy that's in effect today when you file the claim, or the policy that's in effect Monday when you the policy in effect today when you had the accident, or the policy in effect Monday when you file the claim? Okay, for auto insurance, the policy that's in effect today when you have the accident pays the claim, even though you filed your claim in the future. Okay, So again, as you can read there, it covers losses that occurred during the policy period, no matter when the claim was filed. Now, the bottom two, claims made in discovery form, associate that with health insurance. You hurt your back 5 years ago. All right, you buy a health insurance policy today. 2 months later, your back's kind of bothering you when you go in and you need surgery. Which policy is going to cover the cost for your surgery? The policy that was in effect 5 years ago when you first hurt your back, or the policy that's in effect now when you're filing your claim for your surgery? Well, for health insurance, it's the policy that's in effect now when you're filing the claim for the surgery. Okay, that means this policy can cover stuff that happened before you bought the policy. All right, and that's what you do is you set a retroactive date. And by setting a retroactive date, that's the earliest date that this policy will cover you, up until the date of the policy and for the next year. So it's the earliest date that we will cover a claim. It's by this policy. Okay. So if you don't set a retroactive date, then actually in the retroactive date section on the policy application, you put none. Well, then this policy goes back in time all the way to the date you open your doors to the business, and we cover you from that day forward plus the next year for this policy period. So you either put a retroactive date, which is the earliest date will cover loss, or you put none, which means we go all the way back in time to when you first open your doors to the public. Okay? So for those of you that are selling insurance, guess what? Your errors and omissions coverage is written as claims made coverage. Okay? That means, let's say you're independent, you got to buy your own errors and omissions, and the first year you sell insurance, you get the cheap stuff. Okay, just because you haven't sold anything and money's tight, you buy the cheap stuff. As you start selling insurance every year, you get better and better coverage because you're worth more in a lawsuit as time goes on. Okay, and so if, let's say 5 years later, someone comes in and files a claim and it's investigated and realized, well, that loss actually happened the first year you sold insurance 5 years ago. Now, which policy would you like to have in place to cover your lawsuit against you? That piece of crap policy you bought the first year you sold insurance, or the most current up-to-date policy with the higher limits that you have in force today? Well, you'd want the most current up-to-date policy with the higher limits. Well, that's how claims made coverage works. Okay, so you have the policy that's in effect now when you file a claim covers it versus that older policy back in the day. Okay, so for different types of businesses, there's different types of ways of setting it up. Some companies, it's better for them to use occurrence made. In some situations, it's better for claims made. Okay, but you got to know the difference for the test. Now, at the bottom of the chart, after the policy ends, there's extended reporting periods. Now, all this is additional time to file a claim and have the policy cover it. So the mini tails, after coverage ends or is canceled, you have up to 60 days to still file a claim and have this policy cover it. Now, once you file the claim, we now cover your medical for up to 5 years. That's the midi tail. Now, these two, the mini and the midi, they're free. All right? But, it just gives you a slight additional time to file a claim. It does not extend your policy coverage period. It just gives you additional time to file a claim and have this policy cover it. Okay, so be wary of that verbiage on the test. Now, if you want to protect future claimants from, anything happen, then at the end of the policy period, or usually during the mini tail, the company will offer you the supplemental extended reporting period. This is treated like a separate policy. Treated like a separate policy. And it makes the claims reporting period an unlimited period of time. Okay. So that means 40 years in the future, someone can file a claim as long as you had a supplemental extended reporting period. It comes back in time to today when the loss actually occurred, and this policy covers it. So it doesn't extend the coverage period. Remember that. It just gives you additional time to file a claim and have this policy cover that loss. So watch out for the verbiage on that. So the retroactive date of a claims-made professional liability policy is always, or like I said, it's the earliest date that we will cover a loss. Right. If an insured discovers an occurrence 75 days after the expiration of a claims-made commercial general liability policy, what must the insured have in order for the loss to be covered? Well, remember the mini tail's 60 days, and if you didn't file a claim, there's no midi tail. So if it's 75 days later and we're going to cover it, that means you had to have purchased that supplemental extended reporting period, which is also called a maxi tail, once in a while called a full tail. Okay. In a claims made, remember, don't read that word. In a claims made general liability policy, how long does an insured have to report a claim which occurred during the policy period? Well, in claims made, you have 60 days to still report it. Okay. Once you report it, remember, we cover your medical for 5 years. All right. Workers' compensation. Now, this is slightly different in every state. All right. Now, a couple of things. I'll probably add this in the next run here. But in California, you can purchase workers' compensation in one of three ways. Number one, private insurance company. Number two, the state fund. And sometimes on your test, it'll be called a competitive state fund because a state fund competes with the private insurance companies for the workers' compensation business. And the third way is to self-fund. To truly self-fund is your company, you don't buy workers' comp for your employees. You just have to show proof that if your employee suffers a loss, you have the ability to pay that claim out of your company's assets. But if some of your employees had some catastrophic losses and you're paying for it out of pocket, you might go bankrupt. And so a more subtle way of self-funding is getting a high deductible workers' compensation policy, like $2 million. And so you're going to pay all your employees workers' comp claims until you pay $2 million. Once you pay $2 million, then the insurance kicks in and covers the rest to keep your company from going bankrupt. Okay. And so, like I said, in California, there are three ways of purchasing workers' comp. Each state's different because some states, there is no state fund. And so you have to buy it through a private insurance company or self-fund. Some states, private insurance companies are not allowed. So you either have to buy from the state fund or self-fund. Now, if you only have a state fund where private insurance companies are not allowed, this is called a monopolistic state fund. Right? Now, it doesn't happen in California, but that's a question that popped up on the test also. Okay. So workers' compensation protects against statutory claims. Whenever you see statutory claims, that means these are benefits that are required to be provided by state law. All right. And so we give you medical. It's unlimited medical. There's no time limit, no dollar limit. All right. Pretty much anything is covered. Let's see, disability income. There's partial disability if you can only, you're disabled at work, but you can work part-time. All right. Then we pay you the other part-time hours you can't work. But if you're totally disabled, permanently totally, or just totally disabled, I should say, look for the 66 2/3 of your gross weekly wages. It's a weird number, but workers' comp benefits are tax-free. Now, if you take your gross wages minus taxation, you're kind of in that 66 2/3 ballpark. That's what that's about. Remember, you can't get a gain. Death benefits are provided in all 50 states. In California, up to $5,000 for burial, and income to your surviving spouse until they remarry, okay, to the tune of 66 2/3 of your gross weekly wages. Right. Rehabilitation is a valuable tool. It's a cost-cutting mechanism to get you educated and trained to jump back into the workforce. The sooner we get you up and running again, the less the company spends in claims. So rehabilitation is a cost-cutting mechanism. Okay. Now, that's part one of a workers' comp policy. But your workers' comp policy also has part two, and that's the employer's liability section. Now, employer's liability protects against what's called common law claims. These are claims that fall out of the workers' compensation side. And so let's say you have a doctor at a hospital and they contract a rare liver disease. They go home, they give it to their spouse. Now, the doctor would be covered under workers' comp because they're employed by the hospital. The spouse would not be because they don't even work at the hospital. So the spouse could file a claim against the employer's liability section because they got it from their spouse who's a doctor at the hospital, right? So they got it from their spouse who got it from the hospital. And so they can file a claim, like I said, under the employer's liability section of the workers' comp policy, and it could cover their medical bills. And so, like I said, employer's liability covers those people that fall out of the workers' compensation side. Okay. The downside of employer's liability is this bottom bullet right here. That employer has an unlimited lawsuit potential. Okay. But that's workers' comp employer's liability. And there's more to it. In my course, on my online stuff, I do have some more materials. So at this point in time, if you have not registered, seriously consider it. Go to lgdstudy.com. There's a PayPal link next to the property and casualty, or I think it might say fire and casualty. People get confused by that. Remember, property and fire are interchangeable for the test. Any questions, give me a holler or email me. And at this point in time, I'm going to open up to some more questions here. So, all right. Is everyone, some of you self-muted, so I'm opening up. Any questions, feel free to ask. Okay. Any questions?
Yes, Lauren, I do have one question.
You got it.
When I took my test, there was a question about a boat being in a garage that was I think it was something to the effect of a boat that was in a garage got damaged.
Okay.
And yeah,
how did it get damaged?
I don't really remember how the question was worded, but it had something to do with whether it was going to be covered by the boat insurance or the homeowner's insurance.
Okay. Now, watercraft, including trailers, there is coverage up to $1,500. Okay. So, but it wouldn't be if you had the boat owner's policy. Well, let's put it this way, because treat it like your auto. So your auto's in the garage, and the garage is destroyed by a fire. Now, your homeowner's policy covers the garage, right? But it wouldn't cover your auto because your auto is covered by your auto policy. So if you only had liability coverage only, there's no coverage for that auto.
Right, that makes sense.
So there might be a little more to that question as far as what happened and do they have a boat owner's policy or is it a watercraft endorsement? If it's a watercraft endorsement, the boat is not covered. If it's a boat owner's policy, then yes, it would be by the boat owner's policy. Okay?
Okay, I think it was that.
You got it. All right. Any other questions out there? They fell asleep. They're watching the Warriors game. Is that what that is? It just started, by the way. All right.
I guess I'll have one. With the bonds, you said the contractor pays the premium for the surety bonds of the work. It's slide number 98.
Yeah. So here's what happens. So let's say you. Whoops. I'm sorry. Whoops. I'm sorry. Let me go back. There we go. Sorry. Okay. So let's say you're a homeowner. Okay. And you want to build a redwood deck in your backyard for a spring party that's coming up. And it's got to be built within this time period. You talk to a contractor and they say, I guarantee you, I can build that redwood deck in your backyard in time for your party. Okay. And you say, whoa. How can you guarantee the work? The contractor says, I will buy a surety bond. Okay. To protect you, the obligee, right? And so if the contractor builds a redwood deck, great, on time, no problem. But if the contractor does not fulfill their obligation, we, the insurance company, pay you, the homeowner, the money to hire another contractor to complete the work on time. And then we, the insurance company, are going to go after that contractor because they did not fulfill on their obligation. Does that make sense?
Okay. Yes.
Okay.
I see.
So they're buying the bond to guarantee their work.
Okay. Thank you.
Okay. You got it. Any other questions out there? Bounce back. It went all the way to the beginning. All right. Well, if there's no other questions, I guess we'll call it a night. Let me make sure, just in case. All right. Well, I want to say thank you for participating. If you do have questions that do come up later on, email me, call me, text me. If you text me, I'll probably call back, by the way, because I'm not going to text like 3 paragraphs. But again, reach out. If you do have questions, reach out. Not a problem. All right. So with that, we'll go ahead and close up. You guys have a good one. Good luck on your exams. and let me know
Thank
how
you.
you do. And subscribe to my YouTube channel. I'm trying to bump it up. So thank you, guys.
Thank you, Lawrence.
All right, take care.